the news flow on the AI story will remain volatile.
Scale is getting to be even more important given the investments that are needed in AI.
Anyone investing solely in AI right now is taking risks they don't need to be taking.
There are some tailwinds for U.S. companies into next year. The earnings engine in the United States is on.
In the end, the fundamentals will dominate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Friday. Good morning. Welcome to Bloomberg Surveillance. Finally getting a spot of positivity, an unusually skeptical December, with stocks building on yesterday's rally. A renewed focus this morning on TikTok, with an agreement being signed with firms including Oracle about a joint venture. Oracle shares higher this morning, and a Bank of Japan rate hike, capping a big week of central bank decisions with Japanese yields at the highest levels going back 30 years. You are seeing just a bit of yen weakening this morning. Danny Berger alongside me this morning. I'm so pleased to say, Danny, it really does seem like such a huge divide between the rest of the world and the United States when it comes to the rate cutting or rate hiking type of backdrop.
100%, because you have, as you say, the Bank of Japan hiking rates to a 30-year high. The ECB yesterday putting things on hold, in a Bloomberg story out shortly after of officials saying the rate cutting cycle is over. Then you had a more divided and hawkish BOE decision. For now, the U.S. is concentrating on CPI. But as we get into this quiet period, how much of the narrative turns into there are holes? So maybe the more important thing is what's happening to bond yields abroad and that pressuring us here at home.
Right now, it seems like people are saying, yes, there were holes in that CPI report. Yes, it was completely unreliable. Yes, you cannot look at this and say that that is how much CPI actually did go down relative to the month before. However, we don't care because it's going to give this Fed a chance to run this economy hot, which is the thesis heading into 2026.
To be fair, Austin Goolsbee, who was one of the FOMC members who dissented in the last decision, he was out yesterday saying that there was a lot to like in the CPI data. He said, yes, you need more than 1 month, but having someone who's maybe on the more hawkish side, kind of confirming that the data's looking better, that was just another feather in the dove's hat. But maybe it's enough just to kind of get this narrative shift that things are cooler, even if, owner's equivalent rent is, some people saying that someone should be fired for it.
Yes, we saw that report yesterday coming out because there just is a zero put there if you don't have the comp. Meanwhile, we are looking ahead to a big year of geopolitics and a question of the government's role in really supporting big tech in the United States. We saw finally there does seem to be some sort of joint venture with TikTok. I think this is really interesting in light of some of the bigger questions about the U.S. government's involvement in big U.S. companies that are considered strategically important.
And Oracle and the Ellisons just keeping a thread in so many of these deals, whether it be this, whether it be Warner Brothers Discovery. How much of this deal making is away from the world of we're buying things because they grow well versus we're buying things because we're closely connected to the government and we want to be involved in whatever national security concerns that the government also has?
I want to hear what Larry Ellison is hearing, because let me tell you, I think that would be actually quite instructive right now in markets. A question about whether we can reprise the Santa Claus rally that isn't this year. We're down about 1% on the S&P so far this month, even with yesterday's bounce this morning, trying to build on that up about 0.25%. I feel like every morning we're up between 0.25% and 0.5%, and then it's a wild ride for the rest of the day. Meanwhile, that euro-dollar cross around that 117 mark, man, it has been pegged there. And you're looking at 10-year yields just marginally higher, up 2 basis points after the Bank of Japan rate hike to 4.14%. Coming up this hour, Kevin Mann of Hennian and Walsh with stocks coming off their best day in 3 weeks. It's a low bar. Heidi Kribo-Redeker of the Council on Foreign Relations on what's next for peace talks between Russia and Ukraine. And Krishna Guha of Evercore ISI on potential holes in the CPI inflation data. What, Swiss cheese? I think that was one thing, or take it with the entire shaker of salt. We begin this hour with stocks rising as markets close out the last full trading week of 2025. Kevin Mann of Hennian and Walsh writing his macro theme in 2026 is follow the money, saying we believe that the bull market will celebrate its 4-year anniversary. However, there will likely be short-term bouts of volatility. Kevin joins us now. Volatility seems to be the theme, and yet money is the trump factor. What we're seeing right now is people flooding back into equities. Is it enough to get the optimism back before the end of the year?
I think optimism will continue in certain areas of the market. And to my quote earlier, I think the areas of the market that led this bull market over the first 3 years may very well not be the areas that lead this bull market over its next 3 years, if in fact it continues that long. But if you follow the money in terms of where all the money was spent in 2025 and will likely be spent in 2026, I still think there's more growth opportunities ahead.
How much is that predicated on this idea of running the economy hot? The idea that the Federal Reserve is going to cut rates on any excuse, even a very holy CPI report, I mean, full of holes, not necessarily religious. There is this feeling that they are looking for reasons to cut rates, even with inflation higher than expected. Is that sort of the base case for you?
Not for me. In fact, if I look to just a week ago from the Fed's dot plot chart at that point in time, they're forecasting just one rate cut in 2026 and one more rate cut in 2027. Now, that could all change next May when we have a new chair of the Federal Reserve. Perhaps we get both of those rate cuts in 2026, but I wouldn't expect too much during the first half of the year. But regardless of what the Federal Reserve does, we know that this AI infrastructure spend is going to continue, albeit through some circular financing levels. We know that the spending on aerospace and defense is going to continue. President Trump announced, I believe, $901 billion going towards defense in the U.S., and we know that NATO countries have committed to spend up to 5% of their GDP on defense by 2035. That's a lot of money going towards defense contractors. And how about power? The AI revolution stops without power. So we need to look at nuclear. We need to look at natural gas, and that brings the utilities into play. And then my biggest theme for 2026 is healthcare. And not traditional healthcare like large cap pharma, but small cap biotech. I think there's going to be more M&A activity. It's going to be focused on those areas such as oncology, obesity drugs, cancer treatments. If you look at the gene editing and gene splicing, that's where all the activity is going to take place. And here's a great stat for you. Over the upcoming years, over 200 drugs are scheduled to come off patent. Associated with those 200 drugs is over $300 billion worth of revenue. As all of those drugs now get subject to generic pricing, where's large cap pharma going to turn to replace all that lost revenue? They're going to have to be acquisitive, and small cap biotech is going to ride that tailwind.
You know, in all of these sectors that you're talking about, you could tie some sort of AI element to it.
Oh,
usually people talk about it as a benefit. But can you talk about the other side? When you think about AI disruption, are there things that you wouldn't touch for fear of disruption, be it enterprise software, be it a radiology company? What do you want to back away from as we try to figure out how AI impacts things?
Sure, I'm going to answer that question a little bit of a different way. To provide a smoother road for investors along this AI revolution, which is going to be a very long road, as we know, filled with many potholes, I think you need to build a diversified portfolio across the entire ecosystem. Don't lean so much into semiconductors and chips and software plays right now. We're still in the infrastructure build-out portion of this revolution. I've said on this program before, I think we're in batting practice of a doubleheader. Batting practice involves infrastructure. The games involve the actual spending and deployment of AI. So I would shift more time and attention to the data center plays, data center construction, electrical connectivity, cooling solutions like a company like Comfort Systems being added to the S&P 500 next Monday. Their stock's up over 100% year to date, yet they're only trading at a forward PE of around 34. Not too rich. And then bring in the utility plays as well and some of the small modular reactors. I think that's a better ride.
Kevin, it also strikes me that a lot of what you're talking about is also happening in private markets, just not in public markets. Can you get the exposure you want just through public equity? Or do you need exposure to private credit, to private equity, to other parts of this ecosystem?
Yes. I've been resistant so far on private credit and private equity because liquidity is paramount to me in our portfolio structures. Liquidity doesn't matter until it matters, and generally during that periods of volatility and crisis. So I don't want to subject to my clients to liquidity concerns. But I think you can find exposure to all those areas of the ecosystem through the public equity market. And I think there's an abundance of opportunities out there. But valuations do matter. And all the means by which these companies are financing the way that they play the AI revolution is important, right? Because to me, there's going to be more losers than winners in the AI revolution. But the best way to find and identify those winners are those who are deploying capital strategically, smartly with the balance sheet to sustain themselves throughout this entire revolution. But don't just look for the next Nvidia of the world. Look to those ancillary benefactors.
Can those ancillary benefactors win without government support? And I say this as the U.S. government gets more involved in picking the winners and losers, and a lot of the issues that we're talking about, in particular in the power area, become increasingly politically motivated. You think about power prices rising 10% in the first 8 months of the year. This raises a question, especially for an administration that wants to bring down costs. How does that factor into the calculus of what some of the profit landscape looks like for these companies?
I would think that the utility sector is an excellent example of an area that will benefit because of government failures with respect to upgrading and maintaining our power grid. Before the AI revolution, our grid was frail, and it was ripe for shutdown. Now, these utility companies aren't going away regardless of the AI revolution. But as we saw with the deal between Microsoft and Constellation Energy to reopen 3 Mile Island, large cap tech's not waiting for the government to fix the grid. They're going out and forming their own strategic partnerships. And then we see the evolution of these small modular reactors from companies like NuScale Power, ironically enough with a ticker of SMR, building these small modular reactors so that data centers can get nuclear power off grid. That's the future, regardless of what the government does. So some of these themes can persist with or without government intervention.
Before we let you go, Kevin,
Yes.
because you're so optimistic, it's been a pretty pessimistic
Cautiously
December.
optimistic.
Cautiously optimistic. Okay, fine, but cautiously optimistic, but optimistic nonetheless.
Yes.
And we're looking at a lot of pessimism to close out the year. Even good earnings reports. Nike's could have been thought of as a good earnings report. Absolutely, stocks tanking. There is this feeling, show me, and then when you show me, it's not going to be enough. What's it going to take to turn around the sentiment?
I think there's a large contingent of investors on Wall Street who really want this perceived AI bubble to burst. And I think for those investors who are waiting for this bubble to burst, they're likely to miss out on the most significant returns that the AI revolution has to offer. But there's going to be a lot more volatility next year than there is this year. We got midterms, we got the partial funding of the federal government coming due at the end of January, we got the debt ceiling debate. All that's going to create some choppiness. But I think this bull market continues into its fourth year in 2026.
Kevin Mann, thank you so much for being with us.
My
Great
pleasure.
to see you. Kevin Mann of Hennian and Walsh here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. Tik Tok and ByteDance have signed agreements to create a U.S. joint venture that will be majority owned by American investors. According to an internal memo seen by Bloomberg, Oracle, Silver Lake Management, and MGX have all signed onto the deal. It is expected to close on January 22nd if approved by Chinese regulators. Oracle shares are up nearly 5% in the pre-market on the news. Meanwhile, the suspected shooter in the Brown University attack and alleged murder of an MIT professor has been found dead. Claudio Manuel Neves Valente was a 48-year-old Portuguese national and former Brown student. The motive for the attacks is unclear. The Trump administration has halted the U.S. green card lottery program, which it claims was used by the suspect. And the Bank of Japan delivering an interest rate hike to raise levels to their highest since 1995. The move is part of a continued shift from ultra-loose policy. Governor Kazuo Ueda signaled markets should expect further gradual increases. A fresh read on consumer prices in Japan also showed inflation rising 3% for November, above the BOJ's 2% target. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. More on the Bank of Japan coming up. Up next, though, standing behind Ukraine.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years.
Heidi Kribo-Redeker of the Council on Foreign Relations joins us next as we do get some insight into the financing of Ukraine from Europe. From New York City, this is Bloomberg Surveillance. Good morning. Try this every single day. Let's try this again. Yesterday, we actually did get a rally, the first one in 5 trading sessions. We had the best day in 3 weeks. We're going to try to build on that, up 0.2% on S&P futures. Just as a reminder, December tends to be a great month, tends to be positive for equities right now. S&P is solidly in the red, down about 1%. The NASDAQ down about 1.5% so far on the month. Yen weakness. Explain this to me. Riddle me this. The Japanese, the Bank of Japan, raised rates to the highest levels going back 30 years, and there is a softening in the Japanese yen, even with a discussion of further rate hikes. Danny Berger, please explain.
I wish I had a good explanation. I mean, to be fair, the one people are offering up is people wanted more hawkishness from Ueda and the Bank of Japan. How much more hawkish could you realistically have gotten? This is a governor and a Bank of Japan who, upon their decision, said that they're going to keep raising rates if the outlook is met, and it looks like the outlook is going to be met. This is not a Bank of Japan or a central bank that typically gives much more forward guidance than that. So I don't really know what else we could have done.
People were looking for more clarity on when they were going to hike rates next, even with the neutral rate estimated between 1% and 2.5%. It just wasn't enough. Will it be enough turning our focus from Japan, from Asia, over to Europe with what the European Union has promised to Ukraine? Under surveillance this morning, standing behind Ukraine.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years.
Here's the latest. The EU leaders striking a deal to provide a 90 billion euro loan for Ukraine's defense efforts against Russia. This as U.S. and Russian officials gear up for negotiations in Miami this weekend. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in the EU Council in Brussels. Ollie, I want to start with you. Can you talk about how surprising this agreement was that they signed on to a 90 billion euro loan financed through group debt rather than seizing Russian assets?
It was fairly surprising, given that Chancellor Merz, the most influential of these leaders in that sort of room, came into the meeting yesterday saying that basically the only real option there was to getting this financing to Ukraine was seizing those Russian assets and getting them to the Ukrainians. What we have got instead is something of, I think we can say, typically European solution to the problem, highly complex, a little bit convoluted, but does take us to where we need to be from the European level. So this is a 0% loan to the tune of 90 billion euros. This will come from the European budget, so this will be backed by joint debt, which is ultimately backed by the Russian assets. Now, to explain that a little bit further, the idea is here, you give the money to Ukraine. Ukraine only needs to pay that money back if they get reparations from Russia. If Russia does not pay those reparations, then the assets come into play. So this solves the problem of getting the money to Ukraine. It solves the problem of Belgium and some of the other countries that had objected to this, because this is a loan that is not backed by all of the EU countries. It's backed by 24 of them, with the exception of Hungary, the Czech Republic, and Slovakia. And then the last point here is that then the member states and the European countries like Germany can say that this sort of risk does not sit on their balance sheet, which is not true, but it's a little bit more complicated than that. So on the one hand, one might say this is an intensely elegant solution to a pretty complex problem. One might also say it's a sort of elaborate can-kicking exercise to figure out what to do with the Russian assets, but later on.
Tyler, from Washington, D.C.'s standpoint, do we have a sense of how much patience President Trump has with Russian leader Vladimir Putin as this discussion goes on?
Yeah. Hey, Lisa. Good morning. Well, it is increasingly clear that the Trump administration has grown frustrated with Russian President Vladimir Putin and the pace that these talks have been progressing. In fact, though, that is part of why we heard from EU officials that this deal Oliver was just outlining came at a crucial time amid concerns that Ukraine may be forced to agree to some unfavorable terms amid this pressure from the White House to get a deal done. And these talks happening in Miami between U.S. and Russian officials this weekend, because while we have seen some progress when it comes to the talks on the European side with Ukraine, including the U.S. this week pledging that we could see a Article 5-like security guarantee in reference to NATO's mutual defense clause, U.S. officials say that that pledge is only on the table for so long. And we know that territory remains a major sticking point, which has put pressure on Ukraine, as President Trump himself has suggested that the country may need to cede land in the eastern Donbass region. Now, ultimately, this weekend, we're going to be watching two separate meetings. It's our understanding that Ukraine will have a meeting with U.S. negotiators that is separate from the one happening in Miami, led by Special Envoy Steve Witkoff and the president's son-in-law, Jared Kushner. Because, Lisa, to your question, the big question really is, what is Russia going to agree to? What will actually get them to the table amid the developments this week about these bolstered security guarantees and a plan to keep Ukraine's army capped at 800,000 troops?
Tyler Kendall, Ollie Crook, to both of you, thank you so much and have a wonderful weekend. Thank you for all the work so far in December. Joining us now is Heidi Kribo-Redeker of the Council on Foreign Relations. Heidi, thank you so much for being with us. You recently wrote a piece about how the structure of financing the European Union agrees on for Ukraine matters. So what have we learned overnight when it comes to the structure they have laid out?
So, I mean, first of all, there was not a question in my mind as to whether or not Ukraine was going to get the financial support from the EU. It was just basically how. And they did it through collective borrowing, which I think, it's a step towards mutualized debt. but it's not. But it is absent, three of the EU countries, namely Hungary, Slovakia, and Czech. And so I think on the one hand, that's good. They came through with the 90 billion. This is just from a timing perspective. I think it had to happen because the IMF is finalizing an $8.1 billion loan to support Ukraine, and there's a huge gap in their financing, and so the EU really needed to step up to provide support. And the 90 billion is going to go a long way there. It's not all the way there because I think the gap that is projected over the next 3 years is 136.5 billion, which is huge. And but this is a big step in the right direction. It also, I think Oliver pointed out, I mean, it's an elegant solution in a way because it takes the burden off of individual countries to actually provide the budget finance from their own individual budgets. So there is a bit of a collective shift. But at the same time, it would have been a lot more powerful to use the Russian sovereign assets. This was something they've been negotiating it for a very, very long time. And it was, I believe, politically a big failure for Chancellor Merz that this didn't get done.
And that's something that Ukraine and Zelensky had been arguing, that it becomes a powerful negotiating force if they were to use the frozen Russian assets. Heidi, on the other side of things, the Belgians had been arguing that it would face legal retribution and just retribution in general if they had used these Russian funds straight up. Is there any merit to the arguments coming from the European capital?
So, Belgium, I think at the end of the day, just really didn't want to do this. They had a lot of popular support in not moving forward to use these immobilized Russian assets. And Euroclear obviously, has the Russians just sued for, in case Euroclear was planning to use any of these assets, even though the structures that were being discussed would have taken the legal burden away from both Euroclear and Belgium. But at the end of the day, this is something where Merz was standing by himself. France and Italy went lukewarm and did not support him, and Belgium just pushed through and decided that this was something that they cared a lot about. I'm of two minds. I think that the EU needs to move towards collective borrowing for its own national security in order to be able to fund, for example, its own defense. But for this, it just needed to get done, and it got done by hook or crook.
What does it change, if anything, Heidi, though, to the political situation of the very highly indebted nations of France, of Italy, of others?
Well, I mean, this is going to be a burden on them, and ideally this would have been an exercise where you didn't have to have any additional funding coming from, in particular, countries like France and Italy, and others that are struggling that don't have the headroom to really borrow or put too much up to support this loan. It's unfortunate because they had an opportunity to actually use a sizable amount of Russian funds, and they weren't able to get there.
Heidi Kribo-Redeker of the Council on Foreign Relations, thank you so much for being with us this morning. And great piece over the weekend that we're going to be reading and parsing through. Right now, we are seeing rates in the Euro region rising. Is this because of the Bank of Japan, or is this because of the collective debt issuance that people are expecting?
Yeah, and that's on top of Germany also saying it would be a record year for their debt issuance in 2026, off the back of an ECB that's also finished with their rate cutting cycle. Again, it adds to the political pressure that's already very present in a lot of these highly indebted European countries. Heidi was talking about some of them, France, Italy, facing those issues live.
Potentially Germany, though, also facing those issues, given the fact that their growth has not picked up. Coming up in just a minute, Alicia Reese of Wedbush as Netflix gains ground in the fight for Warner Brothers Discovery. We'll get the latest there. Plus, Yahira Anand with your morning movers. Nike plunging on a weak sales forecast. Those shares lower by about 10.5%. Running was good. China was not. This is Bloomberg Surveillance. Santa Claus just wasn't in the mood this year. Maybe he'll get a little bit more in the mood. What we are seeing is that lift across the board ahead of the open, similar to what we saw yesterday, and it actually came to fruition yesterday. Can we make that day two? NASDAQ futures leading the charge up 0.4% as some of those areas get inflows once again. People pouring money into U.S. equities with the idea maybe the tech sell-off has gone too far. When you take a look at the bond space, that really is where the interest is, especially in 10-year denominations, given the fact that we saw a Bank of Japan rate hike, as well as potential questions about the fiscal build out in Europe. Right now, we're looking at yields higher over in Japan at the highest levels going back to 1999. And we're looking at yields over in Germany also higher after the joint borrowing plan up to almost 3%. In the U.S., a sympathy sell-off, right? 4.15%. But how much can we see divergence, Danny, between what the U.S. central bank is doing, what the Bank of Japan is doing, and what the ECB is really coming to fruition with?
It's going to be such a push-pull as we continue into 2026, because that is what we have seen yesterday. It was U.S. CPI that dominated the story. You can have a separate debate over the validity of that U.S. CPI, but at the moment, to your point, it's global bond yields which are pressuring things. And that had been the story of the last month. You add that into inflation concerns, and it was a long end of the U.S. curve that was doing the exact opposite of what U.S. policymakers, both in the White House and at the Fed, had been hoping for. So how much does their mission get challenged if you do have an ECB whose rate cutting cycle is done, a BOJ who is hiking, a BOE whose rate cutting cycle maybe is also done? Do you need to see more aggressive action and maybe some fiscal dominance coming from both the Treasury and the Fed working together?
Yeah, hello, balance sheet. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Cracks are emerging in the Nike comeback story, and shares are falling sharply, down more than 10% in the pre-market. The company warning that sales will drop in the quarter, and that's due to two main drags. It's China sales and its Converse brand. But as you mentioned earlier, Lisa, it wasn't all bad. It beat on earnings and revenue in the last quarter, yet not enough to satisfy investors this morning, with shares, as I said, down 10%. Meanwhile, it's a morning of turnaround stories, or attempted turnarounds, and we have FedEx falling 2.6%. Yet the company results showed the company is showing signs of success, with the CEO's overhaul and cost-cutting plans starting to bear fruit, with the company beating on earnings and raising the low end of its profit outlook for the year. Yet a tough market this morning, with shares down 2.6%. And we end on CoreWeave, the tech trade, gaining steam this morning. Shares are up 5.6% this morning on renewed confidence in its growth trajectory. And it's really for two reasons. First, you have OpenAI looking to raise more than $100 billion in a new funding round. That's according to the Journal. And of course, CoreWeave is one of its most critical infrastructure partners, so it could stand to benefit from that. At the same time, CoreWeave is joining a major U.S. government AI initiative called Genesis Mission, so showing its footprint is growing. Lisa.
Thank you so much, Yahaira. We'll keep watching those names, the more leveraged of the tech space. On our radar this morning, the Bank of Japan raising its benchmark rate to the highest level in 30 years and signaling more hikes could be on the way. The move reflecting growing conviction that the Bank of Japan can reach the inflation target it's pursued for more than a decade. It has been 40 months, Danny, since we've seen inflation above that 2% target. A real question here around the neutral rate being somewhere between 1% and 2.5%, according to UEDA. At the same time, people taking this as not as hawkish as they were expecting based on the move in the yen.
I'm so glad I'm not an FX trader, because just on the surface, I would have looked at this and said, yeah, of course, stronger yen. Not only the discussion around the neutral rate, but saying that if their expectations get met, they're going to continue to hike, and it looks like expectations are going to be met. It does introduce an interesting structural change, because bond yields are still moving higher despite what the currency is doing. And that means for the first time, Japan doesn't have the lowest yields. It's now China. So it does mean things are shifting around, even if the yen isn't playing ball.
And it goes to the point you're making, which is how much does that change the landscape? Japanese buyers were a huge source of investment for U.S. treasuries. How much does that shift that and push yields higher in the United States? That continues to be a focus heading into year end. That, to me, is going to be one of the big questions for 2026.
It really will be, because we've seen other times where the carry trade fails, and it has a big impact on U.S. equities. We haven't seen that as much this year. But if you are seeing changes and a Bank of Japan that does become more aggressive, you have to assume that those risks get reintroduced along with, I don't know, what, like the other 1,000 risks that are currently on people's minds for 2026.
And then the question for the United States, how much can the Fed continue to cut rates given this split screen that we see around the world? Economists raising doubts on yesterday's CPI print that showed inflation cooling to a 4-year low in November. The report, which was impacted by the government shutdown, showed inflation rates plummeting in several categories that had long failed to see prices fall. Think about, for example, owner's equivalent rent, the Swiss cheese report that really is leaving more questions about how valid it is to even depend on for the Federal Reserve in January.
It definitely was shelter and owner equivalence rent that everyone zeroed in on because the type of moves we saw were consistent with recessions. And in order to get the moves that we saw in the very, very tiny gains, you'd have to assume 0% for the month before. It led Omar Sharif at Inflation Insights, I think this was maybe the quote of the day, saying, "I'd fire someone, absurd." But what does it mean for data going forward? What does it mean not just for this month, but months to come? In the words of Powell, the data is not just more volatile, it's distorted. So how much faith can you really take in the data we're getting, especially to make decisions that feel like they're on a knife edge, whether to cut or whether to hold?
Yeah, data dependency taking on a new meaning. Meanwhile, TikTok beginning its separation from Chinese parent company ByteDance. Sources telling us here at Bloomberg that the social media giant signed an agreement with U.S. investors led by Oracle to create a new American majority-owned joint venture that will operate independently. More on that coming up. We also have a conversation with Jamison Greer, the trade representative who has been negotiating a lot of the different deals with China, with Europe. He'll be joining us at 8:15 a.m. Eastern. Sticking with media, traders raising bets that Netflix will win the battle for Warner Brothers Discovery after Warner Brothers urged shareholders to reject Paramount Skydance's offer. Alicia Reese of Wedbush has an outperform rating on the stock with a $140 price target and writes the following. While we're skeptical that the deal will pass regulatory scrutiny, a completed deal would allow Netflix to leverage its streaming and production expertise to broaden HBO's reach. Alicia joins us now for more. Alicia, as we see this grind on and some of the latest rhetoric coming out of Warner Brothers, how much does it look like Netflix is ultimately going to be the winner?
Yeah, it looks like shareholders have a big decision to make between, taking Paramount's hostile bid and opting for Netflix. I think listening to the Warner Brothers board, who has rejected Paramount for its financial backing, uncertainty in favor of Netflix, who has more certain financial backing for the deal. The combination, though, and the regulatory issues will be pretty high for both. If it's a Paramount deal, you have a CFIUS review that is not going to be easy, given the sovereign wealth funds that are signed up to back the deal. For Netflix, it's more DOJ on competition, not just on the side for the consumer, but also on the side for those buying content. Netflix would like to put the deal in line with other content purveyors like YouTube. But on the buyer side, YouTube only buys user-generated content for the most part, or pays for rather than buys. And the Hollywood production that would create quite a bit of concentration for U.S. buyers of content. So that really puts the deal in a difficult position to pass all the regulatory scrutiny, as well as just the impact to Hollywood overall, movie theaters and so forth. So I do think that 12 to 18 months will be long and a long dragged out process if they do win the bid.
Alicia, what do we learn just in general about the consolidation that we're expecting in the media space on the heels of this deal? The idea that size really is necessary for survival. How much more are you expecting come in 2026, given the pipeline of M&A that we keep hearing about?
Yeah, I think it's necessary because these standalone studios are having increasingly challenging times trying to keep up with being, competitive in this space. Content production is not inexpensive, and a lot of these studios that have legacy media properties, it makes sense that for instance, Warner Brothers wants to spin that off and move forward. Netflix just wants to move forward with the studios. And the streaming service. That is probably going to continue. We have a few more, standalone studios left. And I think that, the tech companies that have the cash are going to take those over and take those into the next phase of the future in media.
Alicia Reese of Woodbush, thank you so much for being with us. It seems like we are wrapping up with a whole bunch of loose ends, whether it's the TikTok and the Oracle involvement, whether it's the Warner Brothers and Oracle involvement. I feel like Larry Ellison has his fingerprints in absolutely everything as we head into 2026.
It's so true. First of all, how does he find the time? And maybe more importantly for investors, how does he find the money? I mean, Oracle is outright burning cash now with all of the amount that they're spending. So what does it look like them to do a TikTok deal on top of all the data center spending that they're doing, which, by the way, we learned this week some of their financing was getting pulled back in the form of Blue Owl. So they're incredibly busy. And it's kind of this idea that everything has a flavor of some national involvement, whether it be Trump interested in the outcome of CNN, whether it be TikTok and the negotiations with the Chinese. And that's the kind of web of Ellison being tied to all these various deals.
Yeah, I looked at a map of the web of Larry Ellison and, frankly, ChatGPT, OpenAI, and their involvement, their integration in some ways. And my mind started to hurt. It became very difficult to keep track of all of the different financing pathways. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. OpenAI is seeking new funding, valuing the AI startup at up to $830 billion. According to the Wall Street Journal, the company is aiming to raise as much as $100 billion by the end of the first quarter of 2026. With renewed scrutiny over AI investment, it is unclear if OpenAI will reach that goal. Meanwhile, in a major regulatory shift, President Trump signed an executive order directing his administration to move cannabis to Schedule 3. That's a tier reserved for drugs with accepted medical uses and lower abuse potential. Rescheduling the drug could open the door for more clinical research and ease headaches for the cannabis industry by eliminating a punitive tax rule. And Toyota is increasing efforts to appease President Trump. The Japanese automaker shared it will ship 3 models produced in America to Japan next year, a move the company aims to use to meet the needs of its diverse customer base and improve trade relations with the U.S. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, questioning the data.
You do need to be skeptical about the magnitude of those surprises in these data points, given what we know about the government being shut down and how that impacted data collection.
Krishna Guha of Evercore ISI joins us next for the Swiss cheese CPI report, understanding where it was completely non-instructive and where we could actually glean some insights. From New York City, this is Bloomberg Surveillance. Trying to build on what we saw yesterday, a rally finally after 4 straight trading sessions of stocks heading lower after already seeing losses for the month during a period of time that typically is really positive for risk assets. This morning, trying to build on nascent optimism led by the tech space. NASDAQ futures up 0.4%. Both the S&P and Russell 2000 futures up about 0.2%. The action really lies in the bond space. When you take a look not just at the United States, but around the world, you see yields higher after the Bank of Japan raised interest rates to the highest levels going back to 1995 at a time when globally central banks seem to be ending their rate cutting cycle. The U.S. might be moving in a different direction. But Danny, this to me is the theme. How much can the U.S. diverge at a time where global rates are not exactly inflected significantly lower?
It's so true, whether it be German rates, UK, Japan, as you pointed out, also ECB and BOE decisions, to your point, suggesting that maybe we're nearing the end of the rate cutting cycle. So what does that mean as this central bank here in America tries to ease policy if it's getting pressure from abroad? And I should say it's a bond market right now that doesn't seem to be fully pricing in the risk of that. And I say that just through bond market volatility. The MOVE index is currently at its lowest level since 2021. Maybe it's because it's the end of the year. We have CPI out of the way. Who can even trust the data? I know we'll get into that. Maybe that's why it's calm. But it does feel like there's a real risk coming from abroad to this American bond market.
Maybe it has to do with faith in exactly what you were talking about earlier, Danny, which is fiscal dominance. This idea of the Treasury and the Federal Reserve working together to suppress some of this volatility and some of the longer end sell-off that we've seen elsewhere, simply because this is such a political issue. So this is a reason why people are saying, what do we do with the data that we got yesterday? Under surveillance this morning, questioning the data.
The surprise on the inflation side, inflation surprise to the downside. Again, that makes sense to us. We are seeing a lot of leading indicators on the service inflation side that continue to suggest that outside of the tariff story, we should start to see further normalization in inflation towards 2%. You do need to be skeptical about the magnitude of those surprises in these data points, given what we know about the government being shut down and how that impacted data collection.
Here's the latest. Economists casting doubt on November's CPI that showed inflation cooling to a 4-year low after several categories with stubborn prices seemed to nearly evaporate. Krishna Guha of Evercore ISI among the skeptical, writing, "It looks as if the BLS put in zero inflation in multiple categories, biasing the read lower. The Fed will be focused on December and subsequent inflation reports to clarify whether this is noise." Krishna, I am so pleased to say, joins us now. Krishna, great to see you. Thank you for being with us. Let's start there.
Great pleasure.
Did we learn anything from yesterday's CPI, or is it just a shrug and forget and next?
So look, the report could have been hawkish. It could have had some ugly hawkish surprises. It didn't. Instead, it had what on the face of it looked like dovish surprises, though with very, very big question marks about technical decisions that may have biased this significantly lower. So I would say that from a market perspective, from an inflation perspective, the fact that we're discussing whether there is or isn't some good news here is at least better than discussing how seriously we should take some bad news. But I think that's all it is at this juncture. The Fed and the rest of us will really be waiting to look at the data from December onwards to get a sense of what the real signal is here.
Do you think, Krishna, that in general, Fed officials are going to be more willing to look past any kind of aberrations in the data collection and say, look, this just gives us a sense that inflation's moving in the right direction, the employment mandate is moving in the wrong direction. We need to keep more heavily weighting that, which is going to keep us on more dovish footing heading into next year. How much is that an accurate read of what we've seen over the past couple of weeks?
So I think there's certainly some elements of what you've said, but I would be wary about thinking that the data we've gotten, since the December meeting is really going to bias the Fed significantly more dovish, right? The labor market report was not too bad, considering that it covered the period of the shutdown pothole plus that big one-off set of lagged DOGE layoffs. An unemployment rate of 4.56 or 7, whatever it was, with an increase in participation. That's very consistent with what the Fed's forecasts were predicting for the end of the year. So nothing there that really, I think, pushes them more in the direction of cutting. Remember also that the private sector payroll gains for October and November were not bad, weren't great, but they certainly were on the less bad end of the range, I think, of potential outcomes. So certainly the labor data continues to be soft, but it could have been a lot worse with that pothole. So I think the Fed will be focused on seeing from the December data, from the January data, is the labor market recovering from that pothole in line with their expectation. On the inflation front, as we just discussed, the data on the face of it looks dovish. There are massive question marks around that calculation. So I think for most Fed officials, they'll be in, again, wait and learn mode. Let's see what December brings. Let's see what January brings. I don't see anything here that really pushes them into near-term action.
Krishna, you say most Fed officials, and this is where it gets complicated because this has turned into a divided Fed. We saw that with the dissents in the last decision. I have not been able to stop thinking about research and a note that you put out to clients last month where you talked about the discord among the Fed, that it risks evolving into just a healthy discord to a crisis of governance at the Fed. What would that crisis actually look like, Krishna, and how close are we to something of that nature?
So I think, at about the midpoint of the period between the October meeting and the December Fed meeting, we were really in a pretty bad place. And the risk of that kind of crisis of governance, where the Fed chair is no longer able to craft a central view that most people will sign up to, and the Fed ends up becoming more like the Bank of England, where it's a majority vote, counting heads, how many for this policy, how many for that policy. There was clear and present danger of that breaking out at the Fed. I think in the weeks just running up to the December meeting, Fed officials of all kinds pulled back from the brink some and allowed Powell to try to craft a central view, which was, of course, the hawkish hike that we got in December. Not a very hawkish hike for sure, but the idea of combining the hike with a pause, a timeout to wait and learn, and just one cut in the median projection for next year. So I think at this juncture, we are back in a somewhat more stable mode. But the reasons why that crisis of governance of the Fed was threatened in the last intermeeting cycle haven't gone away. The deep divisions over the economic outlook, the political pressures on the Fed that are polarizing people as they worry about independence and others move to align with policy objectives coming out of the administration, perhaps out of sincere conviction themselves, and the looming Powell endgame. They're all there. And so I think the real question is, as we get closer to Powell endgame and the new chair is seated perhaps ahead of taking over as Powell's replacement, what happens then? Do we see that what we saw in the run-up to December turns out to be just the tremor that suggests the earthquake ahead? Or can the next chair keep things together in the way that Powell has been able to in the end at this juncture?
What distinguishes whether a chair can do that or not, Krishna? Just looking at the candidates going forward, which candidates would you be most worried about unable to keep that kind of consensus building happening and preventing any sort of crisis of governance? And then if you do get that crisis of governance, just what does it mean for this all-important body of policy decision-making, not just here in the U.S., but really globally?
So really, in order to be able to continue in the chair-led central consensus building way of making monetary policy that has defined the Fed for at least 30-some years, the chair needs to have the trust of the committee. The chair needs to be credible with the committee. And that means, of course, above all, following a technocratic data and analysis-based approach to monetary policy, rather than appearing to follow a political direction or a set of priors that aren't well supported by the data. Now, obviously, the market knows some of the potential candidates better than others. But I think whoever it is, given the unique circumstances that we are in now, with President Trump putting a lot of pressure on the central bank to do what he thinks is right, to cut rates faster and deeper, the new chair will have to show to the rest of the committee that he's willing to make policy in a technocratic way. That will really determine whether there is then enough goodwill among the others to give the chair some slack and to follow the chair within reasonable tramlines.
Krishna Guha of Evercore, thank you so much for being with us, and we look forward to having you on again next year as we look toward that Fed debate, that Fed race. To me, that really is going to be the key question. How much does that reshape some of the Fed expectations for the entire market?
And it was just interesting to listen to Krishna saying that the reason we didn't get to that brink of crisis of governance is because of Chair Powell. It's because it was a committee that wanted to be able to rally around him as he delivered that cut, be it, a hawkish cut or whatever it is. So what happens when you don't have that? Are we going to see hawks dig in their heels to try to prevent a Trump takeover or political influence, and you get even more divide from the Fed?
The next episode of The Bachelor out next week. Coming up next, Anastasia Amoroso of Partners Group, Jennifer Lawless of the University of Virginia, Amrita Said of Energy Aspects, and Osang Kwan of Wells Fargo as we look ahead to what some are calling is going to be a volatile 2026. From New York, this is Bloomberg Surveillance. Good morning.
It's been narrow, both in the economy and the markets.
It's almost like the stock market is like the tail that's wagging the dog of the economy.
We are expecting that for 2026, inflation is going to be somewhat elevated.
We've talked a lot about the K-shaped economy, but who's been dealing with inflation since 2021? It's been the lower end of the K.
The macro environment is unusually uncertain.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks trying to get into the holiday spirit with futures building on yesterday's rally. Investors pouring into equities to end the year ahead of what some will say is going to be a volatile 2026, as you just heard there. And the Bank of Japan's rate hike sending rates higher despite dovish hopes for the Federal Reserve. To me, Danny Berger, this is the question of the day. How much is the U.S. market at the behest of global rates, which are inflecting away from some of the hopes and dreams that we're hearing from this central bank?
Because, again, it goes in contrast to not just what the U.S. central bank wants, but what this White House wants too. They've been squarely focused since day one on what's happening to yields. So should President Trump get his wish that he gets a Fed of the chair coming in who's going to move rates much lower, what happens if that's not enough because of what's happening globally?
Yeah, and there has been this shift where an increasing number of investors and frankly strategists who come on this show talk about the bull case for stocks and the lack of clarity around bonds. We've heard that time and time again. We see that again this morning in early trading. We saw that in the flows overnight with some huge flows into equity funds. And at the same time, bond funds get kind of tepid reception as people think about what this global trend actually looks like.
It just feels awkward. And I think that's why it's so uncomfortable, even as we get investors, both institution and retail, happy to pour money into this market. Because on one hand, you have bond yields moving higher, which historically has been bad for stocks. I guess not at the moment. And then you continue to talk, especially at the end of the year, of just the pain in some parts of this economy, how the consumer is not doing well, that the job market is slowing, but stocks nearing a record high too. Something about it feels uncomfortable, but even so, all the bullish projections are piling up for 2026. High as 8,000 for year end.
Well, maybe you just need to look at the data. And we got data. Yay. And then people looked at the data and said, actually, maybe we can't count on this in any way, shape, or form. It's sort of adding to this cloud of mystery. It seems like people are continuing with this feeling that the Fed could cut rates early next year, despite the fact that they also are throwing a whole lot of shade, a lot of skepticism in what we got yesterday.
Yeah, one of my favorite turns in the discourse, and I have to say I was among these people who were like, why wouldn't the Fed just delay their decision? Delay it by a couple weeks, get the data in hand, and then they'll have the certainty to move. Oops, looks like if you had done it, it still would have been the same thing. It's foggy, we don't know what's happening, it's distorted, it's confusing. Here we are, same place as we were before the data.
Well, confusing maybe for the bond space, for the equity space, trying to inflect up after what we saw yesterday, a rally for the first time in 5 trading sessions, building on that this morning, although coming off some of the earlier enthusiasm, up just about 0.2% on the S&P, seeing that euro-dollar cross at that 117 level, yields higher across the board. In the United States, 10-year yields are higher by less than what you're seeing over in Germany and Japan, nonetheless, up by about 3 basis points to 4.15%. Coming up this hour, Anastasia Amoroso of Partners Group as investors de-risk from big tech. Jennifer Lawless of the University of Virginia as President Trump's affordability pitch appears to fall flat, and Oh-Sung Kwon of Wells Fargo as doubts grow over U.S. inflation data. We begin this hour with stocks slightly higher as Wall Street looks to end the week with a win. Anastasia Amoroso of Partners Group writing, we don't believe investors should give up on AI into 2026. The current pullback may present opportunity. Anastasia joins us more. Anastasia, great to see you.
Good to see you.
Very much the holiday spirit, I see.
Yes, I brought the holiday spirit.
I think it's great. So coming up, it does feel like people over the past couple of days at least have come back to this idea. Maybe the sell-off is a good thing. It highlights skepticism. It highlights a better entry value. Where are you on that? What have we seen over the past couple of weeks that gives you more confidence?
Right. Well, first of all, as you were saying, maybe the volatility is normal as we get higher and higher at market altitude, so to speak. So maybe that is what we should be accustomed to seeing in 2026. Investors scrutinize things more, and investors question things more. So maybe that is, to your point, a healthy development. I do think it's nice to see the AI trade pull back by 5 or 7 percentage points over the last couple of weeks. Having said that, as I look at what's really driving the AI trade, it is demand, the adoption, it is productivity, and it is monetization. And when I look at all 3 of those categories, I see positive developments there. First of all, let's talk about adoption. Around this table, I'm sure you're using more AI now versus what you did at the beginning of the year. And if you look at kind of the adult population in the United States, 55% is the percentage that use artificial intelligence today. That was about 45% to start the year. We went from a 10% adoption rate economy-wide to about a 17%. So we are moving up that adoption curve, which is great. The second thing, Lisa, that I looked at the other day was the productivity increases. Coming into the year, we were sort of hoping, expecting to see the productivity gains due to artificial intelligence. And when I look back at the last, call it 3 years, you have actually seen measurable productivity gains. Productivity has been average about 2% year-over-year growth versus 1% that we saw in kind of the decade, after the financial crisis. So these are not just wishes, these are tangible productivity gains. We hear that from companies. We see that in our portfolio companies as well. And then the last point, it's all about the monetization. And there too, whether you look at cloud revenues, whether you look at some of the AI LLMs, the likes of OpenAI, their revenues are surging. And I think that trend can continue into 2026. So with all of that, the AI trade is priced better today. So I would step in here for 2026.
The AI trade in pockets, right? I mean, are there areas that are the winners and areas that are the big losers as you do see a consolidation of profitability in a select number of cohorts, right? I mean, at what point is the gain of some players the pain of everybody else? And I point to Micron yesterday doing really well because guess what? They can charge a whole lot more for their chips.
Right. No, that is a really good point. It's not going to be just everybody's a winner. It's not the tide that lifts all the boats. And that's what we think about in our investment committees. We think about whether a company is going to be disrupted by artificial intelligence or is actually going to be helped by artificial intelligence because they're quick enough to embed it. So that's one way to think about it. The other way I would say, Lisa, we should actually draw the distinction between, no, I don't think AI is a bubble, but are there signs of bubble-like valuations in certain parts of the ecosystem? Absolutely. I mean, if you look at, for example, the late stage venture valuations for AI companies versus non-AI companies, they're trading at a premium of something like 250%. It's not the case for earlier stage, but it is the case for later stage. So I think you have to have a question mark around those valuations. But we are finding, I think, winners in artificial intelligence, I would say, in several different categories. The first one is infrastructure. And the shift is now really sort of, yes, we've done data centers for the last 5 years, but it's really more of a focus on energy because that's the bottleneck. We also think about investing in AI companies that have proprietary data. They have vertical expertise and they can leverage that. That's what we think gives them the competitive moat and the best chance to embed artificial intelligence and kind of, invent AI-powered services. And then the last thing is across our portfolio companies, we also have a concerted effort to boost productivity, drive revenue growth, and also enterprise value creation by infusing AI. So that's where we identify the winners. But you're right, there's going to be lots of disruption, lots of companies to avoid as well.
How much of the avoidance doesn't just have to do with, are you producing revenue? Are you being disrupted by it? And maybe there is promise there, but debt loads are getting unmanageable. I mean, Oracle's been the poster child for this, where their spending increases 11-fold and their cash growth has turned into an outright cash burn. You can pick into any company, but even if the promise is big to you, do debt piles like that and cash burn make it enough to make that kind of company no longer attractive?
I mean, look, once again, I think investors should look at Oracle and the likes and scrutinize anybody who is quickly taking on debt and maybe not scaling revenues quickly enough. So I do think that's a healthy development. But when I think about, let's say, the rest of the hyperscalers, they don't have the issue that the market is sort of punishing Oracle for. They have plenty of free cash flow. They have plenty of cash on the sidelines to finance the data center spend. So, and the other thing I would point out, Danny, going into 2026, I certainly would not give up on all the hyperscalers because what you actually see is their earnings trajectory keeps on accelerating towards the tail end of 2026. And we talk about this gap narrowing between the Max 7 versus the 493, but that gap is actually going to widen out once again. For most of the Max 7, perhaps not the specific companies.
But even for the hyperscalers, and specifically the LLMs, the Googles, OpenAI, why isn't it just a Google being the ultimate winner? Because they have the ability with their balance sheet to not charge for their AI models. Why not just run OpenAI into the ground with the inability of them being able to produce revenue, of Google just offering it for free, and then once they're gone, then maybe they can turn around and become a monopoly? Why isn't that the future road that this might go down?
Well, you bring up a couple of good points. Google, first of all, has been investing in artificial intelligence and working on developing artificial intelligence for years, prior to OpenAI. So Google, by all means, should be one of the winners of this AI trend. But the other point I would say is, whether it's Google, whether it's OpenAI, whether it's another platform, it is about that. It is about the platforms. I remember, talking about artificial intelligence back in 2019, and the biggest winners were always going to be the providers of the picks and shovels of AI and a lot of these LLM models. And who's that going to be? Those who have the massive treasure troves of data. And so it's the likes of Google and Meta and others. So I'm not surprised to see, perhaps Google kind of be in the lead once again, as I think they kind of were back in 2019.
Anastasia, there is a big discussion around if there is risk building. And yes, sure, there is risk building. But the question is where. Most people have pointed to private markets as a place of potential risk. I know you're focused on financing companies and financing infrastructure projects through the private markets. How much risk do you really see building heading into 2026?
Right. Well, if you take a step back, Lisa, if you think about the sheer growth of private credit, for example, it went from being a $600 billion asset class to a $1.7 trillion asset class. So by the sheer kind of virtue of growth that we've seen, there's going to be more and more risks. And I think that's what we've seen is some of these idiosyncratic headlines are representative of the growth of the asset class. But when I think about it from the interest coverage ratio perspective, for example, yes, it is dipped from where it was pre-2022, but it's actually troughed and is starting to improve. So the fact that the Fed has cut interest rates actually alleviates, I would say, some of the pressure on private credit. I think what you have to look out for is, there's been lots of money raised in private credit. That money had to be deployed quickly. And, in some cases, it was deployed in large chunks of capital. So was it always appropriately deployed? Was it always properly covenanted for everybody? I don't know. But for us, if we look across our private credit platform on the U.S. side and the European side, on average, I would say 90% of the loans that we've done have a covenant attached to them. So I can't speak for the industry as a whole, but I think, if you had the prudent underwriting standards, despite the growth in the industry, we're in a good place today.
Anastasia, great to see you. Have a wonderful holiday season.
Thanks
Anastasia Amoroso of Partners Group here in studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. EU leaders have agreed on a more than $105 billion loan package to Ukraine for the next 2 years. The interest-free loan will help the country finance its military and economic needs amid its ongoing war with Russia. The loan came together after European leaders failed to agree on a plan to use frozen Russian assets to raise the funds. Meanwhile, the Justice Department has until today to release its files on Jeffrey Epstein. President Trump signed a bill last month giving the agency 30 days to release most of its files related to the late convicted sex offender. The records could show federal investigations into Epstein's sexual abuse and whether any of his associates knew about it or participated. And several drug makers are expected to announce agreements with the Trump administration to cut some drug prices. That's according to Reuters. AbbVie, Bristol-Myers Squibb, Merck, and more are expected to announce a prescription price agreement. This as President Trump ramped up pressure on drug makers as he makes his affordability push. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. Up next to what Yahaira was just talking about, the fight for affordability.
We inherited a mess. And part of what we inherited was the worst inflation in 48 years. And now we're bringing those prices down. But I'll be talking about that.
Jennifer Lawless of the University of Virginia joins us next as President Trump continues his push to get his message through. From New York City, this is Bloomberg Surveillance. Coming into Friday with a bit of a better tone, we are seeing futures higher pretty much across the board as people reassess some of their fears around AI. AI has been leading this morning as people pile money back into the trade. S&P futures higher by 0.2%. Watching global yields. Watch this space. You're seeing a 2 basis point increase on the 10-year yield to 4.15% rounded up, led by the Bank of Japan, led by what we're seeing in the Euro region with yields squarely higher across the world. Meanwhile, a real question here about the Bank of Japan, around some of the other central banks. If they're done with the easing cycle, I mean, this to me really is the question. How much can the Federal Reserve continue to diverge?
I mean, they can attempt to. And how much is the bond market going to allow them to? And how much does it send a global signal that central banks are saying that inflation is still a problem? If you get a U.S. central bank that is cutting, what if this is a bond market that doesn't just price in what's happening globally, but a fear of inflation. And maybe a fear that the central bank, we're talking with Krishna Guha of Evercore ISI, a fear that there would be some breakdown in the consensus building activity of the Fed. There are multiple things that could pressure yields higher and undo any central bank or any government that's attempting to ease conditions. The two would fight against each other.
Inflation's still very much in people's psyches, which is the reason why there is this real dissonance in polls where people feel like affordability prices are out of their control. Under surveillance this morning, the fight for affordability.
We've had tremendous success. We're bringing prices down. We inherited a mess. And part of what we inherited was the worst inflation in 48 years. I say history, but we had the worst inflation. It drove prices up. And now we're bringing those prices down. But I'll be talking about that.
Here's the latest. President Trump heading to North Carolina today as the administration looks to reassure Americans about the rising cost of living. Bloomberg's Tyler Kendall joins us now. Tyler, thank you so much for being back with us. I'd love your thoughts on how he could develop on some of the initiatives that he laid out earlier this week in terms of trying to alleviate some of consumers' concerns.
Yeah. Hey, Lisa. Good morning. Well, this is expected to be part of a series of domestic stops for President Trump, so we can probably expect his rhetoric to develop as this continues. It's all designed, of course, to try to tamp down on concerns around the White House's economic policies after a week where we saw them try to change the narrative amid, of course, falling polling numbers. In fact, I was going to mention how we just had the head of Ipsos polling on Balance of Power who told us that President Trump's support among U.S. adults has now sagged to 39%, and that support is eroding among Republicans. Now, President Trump himself tried to use his primetime speech earlier this week to reassure Americans on the economy, but he also used it to say that his policies haven't fully kicked in yet, right? He spoke about tax cuts under the One Big Beautiful Bill. He spoke about drug pricing coming into effect in the new year, and he spoke about what policy may look like under a new Fed chair he's weighing announcing, of course, in the coming weeks. But there's other ideas that he's floated that we know might not be as tangible, right? The idea for tariff revenue rebate checks that will need congressional approval. But after weeks of really focusing on foreign policy, in the last 24 hours alone, we have seen a slew of domestic policy announcements, everything from the service members getting checks to wins for the cannabis industry to even declaring the days around Christmas a federal holiday this week. There's just a lot being thrown out there at the moment, and the White House is trying to see what may be able to stick and may be able to garner that support. Lisa, I will put one other thing quickly on your radar for tonight. This event is happening in the newly redrawn 1st Congressional District in North Carolina. This is a seat that has predominantly been held by Democrats for decades, but it now looks more likely to go to Republicans in the midterms.
Tyler Kendall, thank you so much for that. Jennifer Lawless, professor of politics and public policy at the University of Virginia, writing, Trump is trying to blame Biden, but this is now the Trump economy, so the message might not resonate the same way it did last year at this time. Jennifer joins us now. Jennifer, great to see you. Thank you for being with us. I want to start with a question of how much the message that President Trump is trying to get out there in a series of speeches is resonating so far in early polling.
Good morning. It doesn't seem like it's resonating. And frankly, we've seen this script before. Basically, the American people are willing to believe what is fed to them if there's some indication that that's what they're experiencing. And people are still experiencing high prices. They're experiencing unemployment. They're experiencing an economy that seems stuck. And so Donald Trump saying that that's just not the case, or that they need to be patient, or that the fruits of his policies haven't kicked in yet, is not what the American people want to hear. And the polling numbers reflect that.
Jennifer, what difference does it make if Trump is able to get some of the policy through that he intends to help with affordability, whether it be a checks to military families or a $2,000 tariff rebate? And we have seen him start to try to lower tariffs on various food goods via Brazil. Will any of that resonate with an American voter heading into the midterms?
It will if that voter can actually feel it in his or her pocket. When people vote, especially in a midterm election, they're often reflecting on whether they feel better now than they did 2 years ago. And Donald Trump made a lot of promises about the economy. People were very dissatisfied with the Biden economy. Donald Trump blamed Biden and said that he could fix it and that he could fix it quickly. So people will look back to those promises. They'll look back to the beginning of the Trump administration and determine whether they think there's been enough progress. Keep in mind, too, though, that although he has made promises about housing affordability, he's made promises about checks to military members, It's important, too, that he is letting the Obamacare subsidies expire. And as a result, starting January 1st, there are going to be more than 20 million people who see their healthcare premiums go up if they can afford insurance at all. So he's not talking about the negative policy implications. And I'm not sure that even if the positive policies go into effect, it's enough to mitigate some of the negatives.
Does it just in general, though, create policy volatility, Jennifer? We saw an incredible amount of that in the first half of this year, especially after Liberation Day, where markets and other commentators spooked the president to pull back from some of the most harsh of tariffs. Should we expect more of that type of volatility in 2026 as he faces pressure from the American public, especially on the heels of more recent local elections?
I think so. And there's even a chance that we'll see more volatility because if we look at what happened in New Jersey and Virginia, and we see the way in which the affordability message really did benefit the Democrats, the Republicans are going to kick into high gear to try and counter it. And we've seen over the course of the last 10 months that when Donald Trump kicks into high gear to counter that, he often goes one step forward and two steps back. And that's not good for the markets. It's also not enough to actually make the American people feel any differently about the economy.
Jennifer, there's a lot of overlap between what President Trump is looking to do and, frankly, what a lot of Democratic Congress members are also looking to do. It seems like whenever there is dissatisfaction, there is a question of what fiscal impulse we can lean on to alleviate some of those concerns. How much does this increase the chance of any kind of fiscal spending next year, given the fact that that seems to be the solution for both sides of the aisle?
So if it was not an election year, I would say that there's a small chance that there would be compromise, but it is an election year, so neither side has any incentive whatsoever, despite the fact that they're supposed to represent the American people, to come together. The Democrats want to make sure that all of Trump's policies fail and that he is saddled with the economy. And Donald Trump and the Republicans want to make sure that the Democrats are seen as obstructionists and that the American people are still blaming Joe Biden for this economy. So the idea that the two parties will come together and try and arrive at some sort of agreement that could ultimately help everybody, frankly, is too unpredictable in terms of its political implications. So I think it's probably a non-starter.
Jennifer Lawless of the University of Virginia, thank you so much for being with us this morning as we look ahead to that speech. We also are going to be speaking with, coming up in less than an hour, Jamieson Greer, the U.S. trade representative under President Trump, who has been negotiating a lot of the trade deals that President Trump has been touting as evening the playing field globally. It raises this issue of how much some of the efforts in 2026 are hampered by cost of living concerns in the United States. We've already seen a number of different tariffs walked back on trying to alleviate price concerns.
Yeah, and it was especially ones that directly hit the consumer. So things like you'd find in your grocery store, coffee coming from Brazil. And it was noticeable when that shift happened. It was after the elections, after, as we were just talking about with Jennifer, the Virginia, the New Jersey gubernatorial races. You really saw a change from this administration. And I'm curious to know whether Trade Representative Jamieson Greer has also gotten that directive. If that colors and how much it colors some of these negotiations going on where the White House is billed it as matters of national security, maybe there's something more important, and that is their political future in 2026 with affordability being front and center.
Yeah, and how much is that revenue going to go to paying for all of these initiatives that we keep hearing about? Because it's going to take a lot of money. At the same time, we are seeing globally a sense that fiscal is starting to come into play. I mean, we're seeing that in Japan with Sanae Tanaka. We're also seeing that with respect to Europe, with respect to not only the financing of Ukraine, but also Germany. And here in the United States, a real question of how much this is going to be really the story next year.
Yeah, is it going to be fiscal dominance? Maybe not even here, but just globally also as debts build across the world.
Right now, coming up, we're going to be talking about the energy side of this. Amrita Sen of Energy Aspects as Chevron continues loading Venezuelan oil amid growing tensions in that region. Plus, Yahira Anand with your morning movers, Nike plunging after their earnings announcement. This is Bloomberg. Getting ready for the holiday week ahead, we are seeing a bit of a lift across the board in futures. Right now, 0.2% gain on the S&P. Take a look at what's going on with the Japanese yen. A weakening trend, 157.30 after the Bank of Japan hiked rates to the highest levels going back to 1995. When you bleed that decision through to the bond space, you have yields at the highest levels going back to 1999 with the 10-year in Japan at 2.02. Why is the yen weakening? Danny, we've been talking about this. Why is the yen weakening? Because people were looking for more guidance about how much they were going to hike rates going forward.
Yeah, but the BOJ never gives that much guidance. So maybe it was all already priced in. really hoping to get more. But what we did get from the BOJ, if you wanted to, you could definitely read it as hawkish, saying that they're still a far way from the neutral rate, that they want to climb up to get there, that should conditions be met, that they're going to continue to hike. And oh, by the way, they said it looks likely that conditions are going to be met. But to your point, I guess the bar was just extremely high. They wanted something very, very clearly hawkish when it came to guidance, and markets were left feeling disappointed.
Meanwhile, markets on the bond space got the message loud and clear. Yields inflected higher across the board, including in the United States on the long end. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. The turnaround story at Nike shows signs of stalling, causing shares to drop now more than 11% in the pre-market. The company warning sales will drop in this quarter due to two major drags. It's China sales and its Converse brand. And we're seeing that spill into the broader footwear sector, with Deckers also down nearly 3% in the pre-market. This is the company behind the sneaker brand Hoka and UGG. Meanwhile, we are seeing Oracle shares jumping in the pre-market, up more than 4% now, on a reporting that it will be part of an American consortium of investors set to take over U.S. operations. Oracle would gain 15% ownership in a deal that analysts say would solidify TikTok as a major cloud customer for Oracle. The development is according to an internal memo seen by Bloomberg, with the deal expected to close on January 22nd. And we end on Lyft. Those shares not getting a lift. They are down 3 3/4% after Wedbush downgraded the stock, with the analysts saying that Lyft is at most risk among the rideshare companies of autonomous vehicles, saying it could sharply disrupt Lyft's business and could hurt its long-term value. Lisa.
Thank you so much, Yahira. On our radar this morning, OpenAI reportedly aiming to raise as much as $100 billion in its latest round of funding. According to the Wall Street Journal, this could bring the value of the company to as much as $830 billion. I just wonder if he'll stop before $1 trillion, or is he going to wait until he gets to that $1 trillion valuation before he goes public?
Well, maybe you need to stay in the private markets in order to get that $1 trillion valuation. So maybe that's what he has to do. I mean, the growth has been crazy. What was it? $500 billion was what they were valued at this fall in their most recent fundraise, according to different reports. Yesterday, the figure was 750. Now we're at 830. In order to get that 66% increase in valuation, what has to have changed for this company? Presumably the today, here and now, not too much has changed in terms of their revenue. Indeed, as they get challenged from Google, it's that promise that's being priced in. And how real will that promise be, especially as they're getting more rivalry and more competition from Google, who has the ability to offer up a model for free and maybe pressure OpenAI and bleed them dry of cash until it's just Google and Gemini left.
Honestly, despite all the skepticism, the fact that they're able to continue lifting their valuation speaks to maybe the lack of broader skepticism overall, maybe a little bit in the past couple of weeks, but overall still a lot of enthusiasm here.
It's like this thing we keep going from, like, oh no, everything's over, AI and the world's collapsing, to like, oh yeah, we're back, this is great, the promise is here, the dream is real.
It sounds like the chip shipments from the United States to China and the story that's been going on there. Reuters reporting that the Trump administration is launching a review that may result in the first shipments of Nvidia's H200 chips being sent to China. The president saying earlier this month he would allow the chip sales to China in exchange for a 25% surcharge. We are seeing Nvidia shares up more than 1%, and we are going to be speaking in about 45 minutes with Jamison Greer, who is the U.S. trade representative, about what this means for the relationship between these two trade partners. Meanwhile, Nike shares, as Yahira was talking about, falling as the company warns of declining sales this quarter brought on by weakness in China and its Converse brand. The company expecting revenue to be down in the low single digits despite progress in North America at the running category. Initially, when this came out, people were excited. And then they looked more closely at some of the commentary about the path ahead and how they're only halfway through this transition period.
Yeah, especially when it comes to China. And I just wonder how much of this is about a local market, of them not being able to innovate to appeal to a Chinese audience, versus a Chinese consumer that wants more homegrown products, that wants to buy locally produced athletic things. And it kind of relates to even FedEx earnings, where for them the sore spot was also shipments between the U.S. and China. It is the bleed through of the tensions between the two nations and of tariffs. Is there a real hit, as Peter Scheer started 2025 talking about of Academy of Securities, that we're about to witness a hit to brand America? Is that what's happening to Nike? Or can you just say it's simply they're not innovating enough?
Yeah, how much is it just that they've got a lot of inventory that they've got to sell at a huge discount? But yes, this is part of the issue. Meanwhile, turning to commodities, Chevron preparing to export 1 million barrels of crude from Venezuela only days after President Donald Trump accused the country of using oil proceeds to fund terrorism. Bloomberg's Will Kennedy joins us now. Will, please give us some clarity. What is going on in Venezuela with oil exports and the U.S. involvement? Who owns what land? Is this the U.S. reclaiming what was taken from them?
Well, with the tanker curbs, what this makes clear and what they said at the time is that the restrictions are on sanctioned oil tankers, those tankers on which the US has placed curbs for being part of the so-called shadow fleet. There are some exports which will not be taken on sanctioned tankers, and those include exports from Chevron, which is under license from the US to be able to continue operating in Venezuela. You spoke to the Chevron CEO a couple of weeks ago, and he made clear that they are in Venezuela for the long haul. No matter who's running the country, they see it as a key strategic asset for them. So the oil will continue to flow as long as that's possible. And, Chevron says they're abiding by all the rules and regulations. What the Trump administration done has placed restrictions on tankers that are sanctioned, which I think is about 40% of those ships that are exporting US crude. It's known not so much as an embargo or a blockade, but as a partial naval quarantine, I think is the phrase. So it does all fit together when you pick apart the policy that the Trump administration has put on Venezuelan exports.
Will, how much is this a model for what we could see from Europe with respect to Russia? The idea that you can enforce sanctions more significantly in, international waters, is that something that you expect to be repeated elsewhere?
I think it's probably quite unique to Venezuela. Obviously, it's backed up by this huge buildup of US naval resources in the Caribbean, unlike anything that I think has been seen in modern history. You've got the biggest US aircraft carrier, the Gerald Ford, in the region. So the US is backing this up with serious military firepower. I think that's much harder to do in the case of Russia. The people who intervening militarily in the case of Russia, of course, right now is Ukraine, which are doing it in a very dramatic way by targeting ships carrying Russian oil exports out of Russia directly and trying to blow them up. And I think we've seen today perhaps that happening, according to some reports, in the Mediterranean as well as the Black Sea. We've seen something happen off West Africa. But I think Europe will continue to impose its sanctions financially, and I think what you've seen is how hard that is and how the shadow fleet finds way to operating by going dark, by using transfers from one ship to the other, that these financial sanctions, they impose costs on the Russians, but they do not stop the flow of oil. It is very hard to stop the flow of oil. There are always techniques, ways that traders can find to try and go around them.
Will Kennedy of Bloomberg, thank you so much for being with us. Now joining us, Amrita Sen of Energy Aspects, who wrote, "While we believe these flows should be exempt from the U.S. blockade, it is possible Venezuelan authorities may not allow them to continue." Amrita joins us now. And Amrita, you raise a great point, this question of what is the reception in Venezuela of some of the U.S.'s moves? Are they still going to leave U.S. exporters alone during this time?
I think that's the million-dollar question, honestly, and I think that's why you've seen some of the price reactions in the physical market. U.S. Gulf Coast, like Mars, for instance, the crude, kind of medium sour crude that trades in the U.S. Gulf Coast, that rallied quite a bit. It's just in anticipation, we think, from the refiners to suggest that potentially that Chevron's flow that comes to the Gulf Coast may not be allowed to continue, in which case they would seek alternative spot barrels, and therefore, they go for something like a Mars. Like I said in the note, right, it's not that that's our base case. We do think that Chevron's flows are exempt and can continue, but if Venezuelan authorities choose to kind of escalate this, and they've already kind of shown a few signs, escorting some petroleum products from their ports via their own kind of navy, I think that's really the risk over here right now.
Maybe that risk is lessened by the fact that this is a global oil market that is sufficiently loose, Amrita. But could anything change in Venezuela, given the trajectory we're on, even if Chevron assets are impacted? Could it have a larger impact on energy markets?
look, Chevron's volumes that they export are about 140,000 barrels per day. So by itself, no, because like you say, we are still looking at a surplus. But if you're talking about, let's say, 500,000 barrels per day, not even the full 1 million plus that they are producing right now, just 500,000 barrels per day of exports being disrupted over time, that will have an impact on global flows because the bulk of it is going to China. And, they have built up a lot of stocks in the short term, but beyond 2 months, they will start to feel the pinch as well. What I would say is that Venezuela, in conjunction, by the way, we still have half of Kazakhstan's production/exports down because of the attack by the Ukrainians on the CPC, the SPM there, which is still not back. And we also have an enormous amount of Russian oil that's building up on water, over 1 million barrels per day. I really do feel that while sentiment is very bearish, and I agree that even our balances are showing these big builds, come January, when everybody reruns their balances for December, with Vens, if it's still off, say, 500,000, 1 million from Russia, a few 100,000 from Kazakhstan, suddenly, even if we build, which we think we will, it may not be as big as some of the fears are in the market. Some banks are calling for 3-4 million barrels per day, which I do think is way too high. And I wonder if we just get a recalibration of expectations then.
There is just a lot of questions just because of risks that inlay in this at a time when the administration is also attempting to keep prices low, and they are acutely aware of what oil prices are doing. Amrita, is there anything to be gained by this administration, especially in the short term, especially as they face midterms in 2026, from the actions that they're taking in Venezuela?
Yeah, and I think that in some ways the biggest geopolitical wild card for next year is this administration, right? Because they are going after several of this. It's not just Venezuela, it's Russia as well. But at the same time, like you say, there's midterms coming up and they're very clear that they don't want high oil prices. But with WTI in the 50s, there is probably room. WTI could easily go up by $10 without really making that much of a difference to retail gasoline prices, at least in the winter. Now, summer is a different story. We do think gasoline markets will be tight. And that's when I think some of these could unravel. But there is a period, it's a window of opportunity where foreign policy could tighten oil markets, and there is still enough slack in the system, which will not raise domestic prices.
Amrita, set of energy aspects. Thank you so much. And have a wonderful Christmas and New Year and holiday season. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anna. And Yahaira.
Hi, Lisa. TikTok and ByteDance have signed agreements to create a U.S. joint venture that will be majority owned by American investors, according to an internal memo seen by Bloomberg, Oracle, Silver Lake Management, and MGX have all signed onto the deal. It is expected to close on January 22nd if approved by Chinese regulators. Oracle shares are up 4.2% in the pre-market on the news. Meanwhile, the FedEx turnaround story is showing signs of success. Earnings for the shipping giant topped estimates, and the company raised the low end of its profit outlook for the year. The surprise boost was driven by volume and pricing gains in the U.S. However, FedEx is still working through several challenges and expects adjusted earnings to dip this period. And the Kennedy Center Board of Trustees voted to rename the institution the Donald J. Trump and the John F. Kennedy Memorial Center for the Performing Arts. It's unclear if the board has the legal authority to change the name of the facility, with current laws bar additional memorials or plaques from being installed after 1983. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, inflation uncertainty.
I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer-term phenomenon.
Bosan Kwan of Wells Fargo joins us next with his bullish forecast for 2026 from New York. This is Bloomberg Surveillance. Good morning. Well, big tech had been in the doghouse. Now it reverts back to being the lead. Right now in equity futures, you do see a bit greater degree of outperformance from the NASDAQ, although it is coming off earlier highs, up about 0.25%, up now only 0.1% on the S&P. And this really is going to be the focus into 2026. Do we get a read over the skepticism that people have of AI truly being able to lead in the next year? Under surveillance this morning, inflation, uncertainty.
I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer term phenomenon. There are still legitimate concerns and questions about, do we get back to 2% inflation absent some sort of economic contraction in 2026, which no one is pricing in right now.
Here's the latest. Concerns over inflation remaining as questions swirl over the accuracy of the November CPI report. The data impacted by the lengthy government shutdown. Oh-Sung Kwon of Wells Fargo joins us now. Oh-Sung has a bullish forecast for next year in the equity space, and it comes to this question of how much does the data even matter if you have a Federal Reserve that is biased to cut rates and a federal government that is biased to run this economy hot?
Yeah, I mean, I think the setup for equities into 2026 is pretty favorable. I mean, the profit cycle is still in an up cycle. We're forecasting 14% growth, EPS growth for the S&P next year, followed by another 13% in 2027. I think liquidity, which we talked quite a lot about, that's going to improve quite a lot in Q1 with the Fed starting to expand its balance sheet. It was a lot sooner and a lot bigger than what we had previously forecasted. And with that, we're going to see a huge uptick in the liquidity environment overall. And I think that's really going to be the bull case for equities as we move into 2026.
But I hear people screaming at the television screen. This isn't actually quantitative easing. This is just trying to ease the technical backdrop for banks that are using the Fed as some sort of backstop. So how does this really increase liquidity? Is this more of a boost to liquidity than some people are accounting for?
I mean, it depends on how you define QE. If QE is really about shortening duration, then it's not a QE. But if QE is about boosting liquidity into the system, because the funding market was really seeing a lot of stress. If you look at the SOFR spread between the SOFR rate versus the Fed funds rate, it blew up back in October to as much as 35 basis points. So there was a real stress that we saw back in October and November in the funding market. I think that was really the main culprit for the sell-off that we saw over the past, or the volatility that we saw over the past 6 weeks or so. And looking at things like Bitcoin, quantum stocks, non-profitable tech, those guys sold off the most. And that's essentially what happens when liquidity dries up. Everyone's risk curve shifts to the left, and the assets that are farthest out the risk curves, the most speculative assets, they get sold the most. I think with liquidity coming back and potentially liquidity conditions overall being actually good in Q1, I think speculation is going to pick back up. I think AI trade is going to work more in the second half of the year than we're thinking. But I think the overall equity market is going to be pretty bullish.
Is that why you have the assumption that into next year, you write in your research that inflation reacceleration is going to be worse for equities than a recession would be? Because a lot of people would look at the dichotomy between the two and say inflation coming off the back of COVID, equities still did well, but it's growth that's really in earnings that's underpinning this equity market. And if we get a recession, then that would be worse.
Yeah, I mean, if I have to think about the probability of recession and inflation, I would assign a higher probability of inflation. I'm not too concerned about inflation either, because I think there's that AI productivity disinflationary pressure that's going to keep inflation pretty low. But there's the fiscal as well as monetary policy that's coming back in to potentially drive inflation higher. So if I have to choose, I would say inflation has a higher potential than recession. But I'm not too concerned about it either.
But inflation would be worse for equities than a recession would be at this point.
I mean, both would be bad. But I think the probability of inflation is probably higher than probability of recession at this point because of fiscal. We estimate about 80 basis points of GDP contribution for the full year 2026. Most of that is happening in the first half of the year, really through the tax return. So I think consumption is going to pick back up. Consumption is 70% of the economy. So I'm not too concerned about the economic downturn.
What's the sort of break the glass moment in the yield space for equities? And I ask this as you do see longer term yields globally creep creep up on the backs of a hawkish move from the Bank of Japan, albeit whatever people are thinking in the currency space, but also this idea that the ECB is getting to the end of their easing cycle. How much do you see this sort of line in the sand, let's say at 4.5% for the 10-year, at 5%, where suddenly the bull case just isn't there?
Yeah, I think it's going to matter more for what works within the equity market. So we're more bullish on the reflation cycle into the first half of the year because of the fiscal stimulus that we're going to get. But if rates climb above 4.5% or so, I think that's potentially what kills the reflation cycle and potentially back into AI. I think closer to 5% is going to be actually pretty bearish for equities.
So in this bullish environment for 2026, the speculative stuff starts doing well again. Is that a healthy bull market? Is that a healthy turn in the continuation of the gains we've seen in equities?
I think, the bull markets typically have a little bit of speculation at least, especially in this AI cycle. There is going to be speculation. It's new technology, and I don't think it's a bubble yet, but I think there's a potential it becomes a bubble in the second half of the year, especially with the Fed continuing with this easing cycle, liquidity being more ample. And I don't think the AI trade is over. There's quite a lot of concerns around AI capex, and because the market started pushing back on hyperscalers capex, there's consensus view is that hyperscalers are going to moderate its capex. And that's been basically what drove the semi and the AI infrastructure sell-off over the past week or so. And if you look at semis versus hyperscalers, over the past week, we have seen a 3.5 standard deviation move, meaning hyperscalers outperform semis by 3.5 standard deviation. And that trade has been diverging. If we start to see hyperscalers sort of reiterating their capex outlook, the funding issues that Oracle and OpenAI are having, those concerns ease going forward and liquidity comes back, I think the AI trade is going to be back on.
Oh-Sung Kwon, thank you so much for being with us. Have a wonderful end of the year. I know you've been traveling a lot and talking to all sorts of people about the year ahead. Oh-Sung Kwon of Wells Fargo. Hopefully we'll see you next year. This really is the question, right? How much can the AI trade participate and keep leading given the skepticism, and how much does it have to given some of the valuations baked in?
Yeah, there's been a real question over this past couple months about whether it is too big to fail or not. It's completely different than the banks. It's not like you can have a run on the bank of deposits or whatever. But there is a scenario where the AI spend is doing so much work in this economy. And I think that's why the fears are bigger this time than maybe other high valuations in markets, because we've gone through so many periods where there are really high valuations. But what happens if some of that cracks? And the cracks mean that these players don't get financing, they're punished for capex, so they pull back on their capex. We're obviously far from that, but it is a real risk.
Yeah, maybe people are worried because they just don't like the valuations and they kind of want to sell off because it kind of feels a little bit like that. They want to buy in at a better valuation. Coming up over the next hour, Alicia Levine of BNY Wealth, U.S. Trade Representative Jamieson Greer on the path ahead for tariffs next year, Ryan Wang of HSBC, and Eric Johnston of Cantor Fitzgerald from New York. You're watching Bloomberg Surveillance.
The news flow on the AI story will remain volatile.
Scale is getting to be even more important given the investments that are needed in AI.
Anyone investing solely in AI right now is taking risks they don't need to be taking.
There are some tailwinds for U.S. companies into next year. The earnings engine in the United States is on.
In the end, the fundamentals will dominate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, finishing up the last trading day of the last full trading week of 2025, finally getting a spot of positivity in an unusually skeptical December, with stocks building on yesterday's rally, although fading from the earlier gains. A renewed focus on TikTok, with an agreement being signed with firms including Oracle about a joint venture, and a Bank of Japan rate hike capping a big week of central bank decisions, with Japanese yields at the highest levels going back to 30 years. And it really raises this question about how much the yield space can drive the optimism that's trying to bleed back into markets, but kind of struggling to do so this morning.
Yeah, and you were just talking about this with Osan Kwan of Wells Fargo, asking what is the level at which equities care yet again about what yields are doing? Why don't equities care about the risk of inflation? Why don't they care if easing that's supposed to be happening in the U.S. is curtailed by what's happening abroad? A lot of the answer would be because we believe in the promise of AI. And even that has had its wobbles this year. But for now, OpenAI gets another big funding round. We had Micron earnings that were great, so the trade's back on.
Yeah, people looking for reasons to get back invested. Actually flows into equities resurging over the past week. The second biggest ever, I believe, into U.S. equities over the past week, trying to capitalize on the sell-off because maybe it's a better entry point, seems to be the theme for a lot of people out there.
And it's remarkable because it's not just institutions, it's retails, it's across the spectrum. People are still buying equities, and you pointed out globally, it's something like a record inflows coming into stocks too. So it's not even just the U.S. It's also been an outperformance year for international stocks too. And I think that's leading people to say, hey, maybe we can repeat this thing in 2026. Of course, the bite of humble pie would be that what we thought would happen this year is not at all what happened. So things can change quickly, especially with the weight of politics in mind.
Maybe people are just putting on pause some of that optimism right now in equities. You're not seeing that gain really lifting throughout the session as the session grows older. Now we're looking at S&P futures that are unchanged. The Japanese yen weaker, dollar stronger, 157.23. There wasn't enough guidance, evidently, with the Bank of Japan promising more rate hikes on any kind of schedule. Nonetheless, the bond market got the message. 10-year yields climbing to the highest level since 1999 in Japan, 2.02%. And in the 10-year, you do see that kind of similar move in the United States at 4.14%, up 2 basis points. Coming up this hour, do not miss this. A wonderful lineup to end the week strong. Alicia Levine of BNY Wealth as equities look to shake off AI volatility. She'll be with us for the hour. U.S. Trade Representative Jamieson Greer, do not miss that as TikTok takes a step to avoid a U.S. ban. And Ryan Wong of HSBC as investors begin to see holes in the latest CPI data. We begin this hour with stocks holding steady on the final day of the last full trading week of 2025. We are all ready for it to be over. Alicia Levine of BNY Wealth is bullish. Heading into 2026, she writes, we see a non-linear year with enough fiscal, monetary, and earnings support to move the S&P higher. Alicia joins us now for more. Alicia, great to see you. Thank you for being here.
Great to see you guys.
So everyone's talking about optimism for next year with a bunch of different risks. Volatility, yes. Does the sell-off that we've seen over the past couple of weeks give you actually more confidence heading into 2026 about that bullish outlook?
So I think that investors have learned that sell-offs tend to be buying opportunities. We thought so as well. But I don't think we've seen the final absorbing of volatility in markets in the next 12 months. We do see lots of issues out there for next year, even as we talk about, the Fed is in a cutting cycle, earnings are in an upcycle, margins are in an upcycle, and of course, fiscal support is in an upcycle. So there will be lots of supports out there for earnings and therefore for markets, but it'll be a volatile year. So what investors have learned over the last 10 years, anytime you see a 15 to 20% drawdown, it becomes a buying opportunity. And I think, next year, should we get that kind of volatility, it'll be the same.
It does feel, though, that those opportunities are rare, that you get like one day of a pretty harsh sell-off and people are saying, oh, we're buying the dip and it's something like 1%. Would you want to wait for those bigger sell-offs to get into the market? If you do have more money to be put to work, would you wait for that moment in order to buy in?
So our message to clients is never time the market, because it's actually quite impossible to do that. And actually, this year was the perfect year for that. So we have a chart where we show clients if you miss the 10 best days every year over the last 25 years, and basically your returns double if you just stayed in the market. But this year is actually more extraordinary because it was so volatile. If you tried to time the market this year and you were out because of tariffs and you were concerned and you were waiting for data to help you, if you missed the 10 best days this year, you were actually down 12% year to date. Versus if you just stayed in the market, covered your eyes and sat there, you're up 16 to 17%. So that is a 29% difference in your return trying to time the market and feeling like something really noxious was coming out of policy. So we see something like that for next year as well, meaning don't time this. Ultimately, investors have to say, what are the fundamentals? Where are earnings going? Where are margins going? we see 13% earnings growth next year. Therefore, if you take a 12-month view, we end the year higher, but that's not without fits and starts along the way.
Can you extend that to small caps? They're on, I believe it's something like an 8-month run. They've been up a lot,
and by the way,
since 2021.
Small caps are now pretty close to the return of the S&P, and I think most people wouldn't have realized that. And that was all the work was done in the last few weeks on the small cap side. So yes, so we are telling clients that the market is overly concentrated on concentration because the earnings growth is actually coming from the other 493 going into 2026. And with the kind of fiscal support that we have and the Fed cutting cycle, that's great for down cap markets. And the deregulatory agenda and the M&A that we see happening, Merger Monday, every week now, is actually quite good for down caps. That means mid cap and small cap. And these indices are chock full of cyclicals, financials, healthcare, and industrials. And that's what's been working. And we see that continuing into next year. Don't forget, these indices really underperformed for the last 3 years, and markedly so.
Alicia Levine of BNY Wealth sticking with us for the hour. We're going to be talking about policy, some of the loosening on the fiscal side, as well as potential hiccups coming up. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. OpenAI is seeking new funding, valuing the AI startup at up to $830 billion. According to the Wall Street Journal, the company is aiming to raise as much as $100 billion by the end of the first quarter of 2026. With renewed scrutiny over AI investment, though, it is unclear if OpenAI will reach that goal. Meanwhile, several drug makers are expected to announce agreements with the Trump administration to cut some drug prices. That's according to Reuters. AbbVie, Bristol Myers Squibb, Merck, and more are expected to announce a prescription price agreement. This as President Trump ramps up pressure on drug makers as he makes a push on affordability. And President Trump signed an executive order giving government employees a 5-day weekend for the holidays with days off on Christmas Eve and December 26th. Not everyone getting extra days off, though. The New York Stock Exchange and the NASDAQ both say they will not alter their trading schedules on those days, so we will be here too. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I imagine a lot of people were saying, yes, please make that happen, right? I mean, how many people were like, okay.
Okay, my mind went to people who are holding options that would have expired then and were like, uh-oh, this isn't good for me. I need to rethink some things.
Well, up next, we're going to be taking a shift to the international. The morning calls plus U.S. Trade Representative Jamieson Greer as TikTok takes another step to avoid a U.S. ban. Now the question goes to China. Will they sign off? This is Bloomberg Surveillance. Good morning. The enthusiasm fading throughout the morning. Good morning. We are seeing really a struggle to try to generate the kind of gains we saw yesterday, flat essentially on S&P futures after having been up by about 0.2%. Yields higher by about 2 basis points here in the United States, 4.14% on the back of a Bank of Japan rate hike that left people wondering about long-term yields globally and how much that is going to drive what happens here in the United States. Turning to deals, TikTok saying it reached binding agreements for a new U.S. joint venture, majority owned by American investors. The company's CEO telling employees agreements with Oracle, Silver Lake Management, and MGX have been signed. Joining us now as we parse through everything that has happened in 2025 around the trade story is the 20th U.S. Trade Representative Jamieson Greer. Representative Greer, I want to start on how busy 2025 really was. Looking ahead to 2026, do you expect the same kind of pace with respect to trade deals, with respect to trade announcements?
Well, during 2025, President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. We've announced lots of trade deals. We've announced lots of tariffs, as you know. In the coming year, we expect to finalize a bunch of those trade deals as well. I think that the tariff plan is in good shape. I think we have a lot of the tariffs we want in place. If there are countries here and there that don't comply with their deals or don't want to finish a deal, then maybe we have to have another conversation. But I think the economy's booming, inflation's down, wages are up. We're on a really great track.
How much are you potentially at risk should the Supreme Court overturn some of the tariffs that have been enacted under the IEEPA provision? Do you have something in place to get those tariffs through other measures, or will there be a rethink about what will be put on and what won't?
Well, it would be terrible if the Supreme Court overturned the case, because we have built a new global trading order on the back of these tariffs and the tariff system. And our trading partners have accepted it, and they've made deals, and they've accepted there's going to be some tariff level to help protect U.S. industry. So it would be disastrous if this was pulled out. All that being said, we will do whatever we need to do to make sure that we can maintain the tariffs we need and keep the deals in place. Obviously, we want the flexibility of the emergency powers that Congress has given to the president. That's the most effective way to deal with it. It's what's made him so effective this year in negotiating. But absent that, we'll work and we'll find a way to make sure we can keep all these gains we've made over the past year.
Representative Greer, there's also a feeling right now that cost of living concerns are coming to the fore, and President Trump has talked about removing some of tariffs on specific goods, particularly having to do with food, as a way of alleviating some of the price concerns. How does that factor into discussions going forward? Do you think that will be an increasing part of your thought process as you go through some of these trade negotiations?
Well, any good president wants to address affordability, and our president is. And over the past month, we saw dairy, fruit and vegetables, all kinds of prices go down for basic staples. So that's a great development. Going forward, the president removed some tariffs in connection with some deals related to food coming from abroad, bananas, coffee, cocoa, the kinds of things we just don't make in the United States. The United States is a food powerhouse. When we saw inflation earlier, it's really about housing, health care, driven by Obamacare disaster. So I don't think that, food imports are really going to be an issue for us. The tariff program is really about creating jobs, and the president's regulatory approach is really about bringing prices down and bringing affordability.
Ambassador, have you had any specific directives from the president, though, as you carry out your negotiations to make sure any tariffs you put on from here or any ones that you negotiate specifically are not having an impact on affordability?
So the way you put it there, a specific direction, I would say no. Whenever we're imposing tariffs or doing deals, the purpose of the trade program is to reshore American manufacturing and protect American food security. It's really about jobs and increasing wages, which we've seen over the past few months. When it comes to prices, the president is undertaking a lot of other actions, energy policy, tax policy, regulatory, gas prices are down, et cetera. So we don't see the trade policy really as driving prices. We see it as driving jobs.
Ambassador, I'd love to go back where Lisa started, and that is it looks more likely that we indeed have something of a Tik Tok deal where U.S. buyers will take the American portion. You, after some of the negotiations in Madrid, were talking about how this deal, how this company was part and parcel of a variety of matters when it comes to negotiating with your Chinese counterparts. So have you had more discussions about this deal with Tik Tok? Does it seem likely that China will let it happen?
So there are two layers to the Tik Tok deal. One is the private sector layer, where the private parties are concluding a deal. And then there's a layer of government approvals between the United States and China. And so my conversations with the Chinese government over the past few months, as you mentioned, have covered a variety of issues. One of them has been Tik Tok. Back at our discussions in Madrid, we came to an essential agreement that if the private parties came to agreement, that the Chinese would approve it. So we expect approval by the government of China in alignment with that agreement we reached earlier this year.
We're hearing about not only this deal with respect to Tik Tok and some investors in the U.S., but also a review process to sell H200 chips into China. And I'm just wondering, stepping back, if all of these are pieces of a bigger deal that will come to fruition in 2026 between the U.S. and China.
I would say with the H200 export control issues, those really are standalone. That was not a negotiated outcome in the United States with respect to export controls. Those are not something that are really subject to negotiation. Those are national security and commercial decisions made by the federal government. So that's kind of standing on its own. With respect to the rest of the China deal, right now we're trying to make sure that rare earths continue flowing from China. They've bought over 5 million metric tons of soybeans at this point, and we're trying to keep trade flowing between the two countries in a way that makes sense.
Do you expect a bigger deal other than just sort of steady reset kind of idea that we've talked about with respect to the U.S. and China? Do you expect something more comprehensive to be outlined next year?
It's a little hard to say at this point. Goal one is stability. For me, and everyone's heard me say this before, we need trade with China to be much more balanced. Our trade deficit with China has decreased by 25% this year alone under President Trump's policy, so that's going the right direction. I can foresee a situation in the first half of next year where we come to some kind of agreement with China on exactly what we should be trading with each other and even in what volumes. It's a little bit of managed trade, but it's the kind of thing that can be healthy and stable. Given the way that Chinese government runs its economy, it just doesn't mesh very well with the way we want to run our economy. That just means we have to manage it a little bit more, and I think there's a possibility of that. I'm not sure I'd call it comprehensive, but I'd call it confidence building.
Ambassador, I think a lot of the confusion for many people comes around national security. One of the points that you mentioned just a moment ago, especially things with H200 chips, giving chips to China was seen an issue of national security, even giving F-35s to Saudi Arabia. What does that mean for national security? Because critics would say that it means that national security is up for sale. What would you say to those critics?
So with respect to the F-35s, that's not my. I used to be in the Air Force, but it's not my wheelhouse. On the H-200s and export controls generally, export controls have always been fluid. They've never been static. The very nature of export controls is that the U.S. government is constantly reviewing the state of technology and assessing what technologies can be sold and which ones can't, and balancing national security and assessing whether or not there's foreign availability. Everyone knows that the Chinese are quickly also trying to develop their own AI chips, semiconductor tools to make those chips, etc. It's a race. All of those H200 approvals still have to go through the Commerce Department to make sure that any licenses that are granted really respect U.S. national security and make sure that it's not violated, and there can be conditions on licenses, et cetera, to make sure they go to end users and end uses that don't jeopardize U.S. national security.
Is it fair to say then, Ambassador, that even if this does go through, the kind of cases where this is allowed, where it's approved, will still be quite limited in scope?
So it's hard to say at this point that these types of license applications are typically case by case and reviewed. So, we'll see. The way it's set up right now is if the chips are going to go to China, they come back to the U.S. for a security inspection to make sure that they are indeed the types of chips that are being allowed to be sent to the Chinese. We know there are a lot of Chinese companies that want them. We know the Chinese government's pretty interested in having their own domestic champions build them. So the Chinese themselves right now are having a conversation about the types of chips that they want from the United States. We think that they want the H200s. They've shown an interest in that. So we'll see. Between their process and ours, we'll see where it goes.
It seems like the tech wars have been behind a lot of the negotiations over the past 12 months, in particular, not only with China, but also the European Union. I'm just wondering where some of those discussions are with respect to some of the restrictions and regulatory investigations Europe has been making toward U.S. tech companies. Where are some of those discussions?
So I just had a conversation yesterday with my counterpart in the European Commission yesterday to reinforce some of the strong concerns we're hearing from U.S. stakeholders. U.S. tech companies are the most competitive in the world, and Europe, frankly, doesn't have those types of competitors. If you talk to the Europeans, they'll say that's why we have to regulate and have these protectionist measures against U.S. tech companies. Unfortunately, we see in the way that they've developed those measures, they're discriminatory. They only capture companies above a certain threshold of revenue globally or certain business models, and magically it only happens to capture U.S. companies. They'll say that they're Chinese companies too, but we only see actions against American companies, so it's a problem. It's discriminatory in fact. You'll hear the Europeans say, well, it's fair, but it's discriminatory in fact and in intent. So I want to talk to these folks. I want to negotiate over it. They've been somewhat resistant to that, but again, I had a great conversation yesterday with the European Trade Commissioner, and I think we just have to be able to talk about why they're doing this, why they're purporting to regulate American companies and their global business models.
Ambassador, coming into 2025, a lot of people were wondering who our allies and who our adversaries would be on trade. And we were talking about who traditionally have been U.S. allies and who haven't. Have you been surprised at who's been most difficult to deal with in 2025? It has surprised a lot of people in the markets to see the likes of Europe be a more contentious discussion than other regions, even sometimes China.
That's because they haven't been trade negotiators. I have not been surprised at where it's been more challenging. Take India, for example, who's an important partner and a strategic partner in a lot of ways. We started negotiating with them early in the year, and we're still negotiating with them to try to find a good landing zone. During that time, we have other trade partners who have come in, started, proceeded with, and concluded trade negotiations with us, et cetera. The reality is somebody like Europe, and frankly, some jurisdictions that want to emulate them, they might have relatively low tariffs compared to the rest of the world, but they have non-tariff barriers, regulations that exclude American agriculture, which is one of our major exports, and regulations that exclude our industrial exports. And so you get into and this is why we have giant imbalances. It's not because Europe is really competitive. We know they're not. It's because they have a lot of these rules that prevent U.S. goods and services from going into the continent.
Ambassador Greer, just to finish up on Mexico, which has been negotiating from what we understand, they just recently gave final approval to put tariffs on certain Chinese imports, and a lot of people are expecting there to be some sort of reprieve with respect to aluminum and steel tariffs on Mexico. Is there any discussion about that going on right now?
So first of all, any country in the world who exports steel and aluminum to the United States wants to have a modification to that regime, because the United States for many years has been the consumer of last resort. And this is why the president put steel and aluminum tariffs on in the first administration. The Biden administration kept them, and the president has tightened them further in his second administration. Of course, the Mexicans are asking for this. We have found the Mexicans to be quite constructive in some of our recent discussions and looking to change some of their laws and regulations related to longstanding U.S. concerns. So have the Mexicans asked about this? Yes. I won't give any further detail beyond that, but it's certainly something that they would like to see. It's not surprising.
Ambassador Greer, thank you so much for being with us this morning, and have a wonderful rest of the year. Ambassador Jameson Greer speaking with us, really indicating how much we're seeing this kind of shift to not exactly the hot boil that we saw this year. And I would love, Alicia, your take just quickly on how much people are expecting peak uncertainty with tariffs behind us and smooth sailing going forward.
So despite the fact that everybody's waiting on SCOTUS, I'm not sure that's really the game changer here, even though it'll introduce some uncertainty on the how. But it seems clear the administration is intent on having tariffs. Peak uncertainty on tariffs was May and April of 2025. And the market has told us that it's essentially behind us now. So I guess you could say one of the risks would be if it just reemerges as an issue, because right now the tariff collections are coming in far lower than the statutory rate.
We'll continue this conversation in just a minute. Coming up, Ryan Wong of HSBC as some analysts cast doubt on U.S. inflation. Plus, Yahira Anand with your morning movers as we try to get some sort of rally to end the last trading week of 2025. Trying to build on what we saw yesterday with a little bit of positivity, at least in the tech space, not so much everywhere else, just really fading as the session grows older. NASDAQ futures up 0.2%. Russell 2000 also up almost the same amount. Curious, given what we're seeing in the bond space, 2s, 10s, and 30s, yields climbing at the longer end of the yield curve, not because of CPI yesterday, but because of what we saw from the Bank of Japan, hiking rates to the highest levels going back 30 years, 30-year yields rising in sympathy, 4.83%, really have been pinned there. Danny, to me, this is really the story. They've been pegged at this higher level, and people saying it's okay because ultimately the economy is strong enough to look past this.
Right. It's been trading in a really tight range too, in that same level. So maybe that's why it's like, okay, maybe the level isn't great, but the direction is not concerning. But then you also have volatility trading really low. How much of that though does get disrupted from what we're seeing globally? And that is the story of this morning, and likely it's going to be the story of 2026, with Bank of Japan, BOE, and ECB signaling that either they're hiking in the case of Japan or that their rate cutting cycle is over.
Yeah, the global story also very much front and focus for corporations. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. The housing market continues to challenge the home builders. We saw that with Lennar earlier this week, and now with KB Homes. Shares are falling 4.25% after they delivered fewer homes than expected, while profit also weakened in the last quarter. That's thanks to those big incentives that they've been offering buyers to get them in their homes. KB Homes also issuing a weaker outlook than expected as those challenges around affordability and mortgage rates look set to remain. Meanwhile, we are seeing Oracle shares rising nearly 4.6% in the pre-market on a reporting that it will be part of an American consortium of investors set to take over TikTok's U.S. operations. Oracle would gain 15% ownership under the deal, which analysts are saying would lock in TikTok as a major cloud customer for Oracle. This is all according to a memo seen by Bloomberg, with the deal expected to close on January 22nd. And we end on Nike, big mover to the downside, down now 11.6% after the company warned that sales will drop this quarter, and that's thanks to two major issues. It's China sales and its Converse brand. The weakness surprising investors after 2 straight quarters from Nike of growth. The negativity also spilling into the broader footwear sector, with Deckers, which makes the UGG and Hoka shoe brands, also falling down 3% in the pre-market. Lisa?
Thank you so much, Yahairo. Meanwhile, Wall Street casting doubt in November's CPI report, hitting a 4-year low after several categories with previously stubborn inflation appeared to nearly evaporate. Bloomberg's Michael McKee joins us now. Mike, what's the latest when people parse through this, particularly with respect to owner's equivalent rent?
Basically, you just have to look past this, and that's what most people are going to do. Nobody thinks that BLS did anything wrong, illegal, put it that way, or conspiratorial. But they did have a statistical issue with how you deal with the fact that there were no October data. And so what they did was just move September data into the October boxes, and that ended up meaning that there was, for housing, zero change in prices, which is not likely at all. So everybody's looking past this, and we'll get the December CPI numbers in January, and that'll be much more dispositive as far as what the Fed's going to do.
Thank you so much, Michael McKee, and we'll be looking forward to that data with possibly more clarity. Alicia Levine, head of investment strategy and equities at BNY Wealth, still with us. I'm just curious what your takeaway was from the CPI report we got yesterday.
Well, of course, there was that first shock, like, wow, it's much lower. But then it became clear that there are donut holes there. So I think overall, better that inflation report was weaker than stronger, and really good that we don't have to debate whether or not the higher readings are real or not. But I think ultimately the market told you yesterday, the bond market told you yesterday, that we understand that this data is not quite firm enough, and we'll have to wait and see. I think overall, the last 2-3 months, and all the data reads, the comparisons have been very hard. The collections have been difficult. So the Fed is working in a little bit of a data vacuum still, because it's very hard to have a month-over-month read when you're not quite sure if the collection was the same as it was historically.
How much does inflation boost the case for equities beyond the case of fixed income, beyond the case of almost any other asset class?
So I think you really have to separate it here, because clearly inflation reads for fixed income are quite difficult, and small changes can matter a lot in market pricing and in portfolios. On the equity market, it's a very different thing, because earnings are nominal, meaning it takes into account inflation. And so any bit of inflation that does not cause a Fed pivot, right? The key here is the Fed pivot. And the pivot meaning from a cut or a hold to a hike. So as long as inflation is somewhere in that place where the Fed is not pivoting, then it's actually fine for equities, and that inflationary piece gets reflected in market pricing because it gets reflected in earnings. So very different in your asset classes, which asset classes can handle a little bit of extra inflation and which not.
Yeah, and the idea of a hike right now, very much not on the Fed's picture.
And of course, that would be a risk.
That would be a risk.
That would be a risk.
But right now, doesn't seem to be in anybody's bingo card for next year. Ryan Wong of HSBC joins us now to parse through what we have heard. Ryan, do you think it is appropriate to just look through yesterday's CPI report?
Well, I'm not sure we can just entirely look through that release. Now, it's true that the most analyzed portion of that report did relate to the rental inflation, and I do think it's fair to say that the number itself was likely distorted on the rental side. But we still have to build a new fact pattern for what rents will look like as we go into next year, because actually there had been some evidence even prior to yesterday's report that rental inflation has been slowing gradually. So I don't think we can entirely dismiss it. And then, yes, if we look at the other components of the report, they also surprised the downside. Maybe there were some seasonal distortions. Of course, we are, going into the holiday season, so therefore the timing of when that data collection happened might have led to some of that downward distortion.
How are you thinking more generally, Ryan, about the data and the quality of data itself, whether it's good enough to make decisions by the Fed, or whether this is a Fed that is in hold not just because of the pressure from the dual mandates, but because of the lack of clarity from the numbers themselves?
Well, I think in the United States, the one thing is we do have an extreme wealth of data, right? We have so many numbers. That's why, we had this historic week this week where we had these highly unusual jobs reports and highly unusual inflation numbers. But then we have all this other secondary indicators and private sector indicators. And then we have the anecdotal information from the Beige Book. So there's plenty to analyze. I don't think that's really the issue. I think, the disagreements on the Fed are fundamental. They are about, what is the better approach for policy rates? Do you still need to slow down the economy to bring down those inflation numbers even further? Or is it fine to just sort of sit where you are for some time and allow the economy to adjust to the current level of interest rates?
We were speaking with Krishna Guha of Evercore earlier, who said that he was worried, not as much at this moment, but it is a real threat to have some breakdown in the Fed. A crisis of governance is what he called it, when Powell is no longer there and you have someone at the head of the Fed who can't coalesce a consensus. That it's not just an issue of disagreeing opinions, but it's about a lack of ability to communicate. It's about politics getting more deeply entrenched. Is that a risk for you in 2026?
Well, it's something to watch for. I mean, we heard from Fed Chair Powell that he wants to deliver the economy in a strong place to his successor. And so, look, the new Fed chair is going to have a new communication style, is going to have a new way of doing things, may have a new approach to all of these issues, assessing the economy and then delivering that message to the markets and to the public more broadly. So, look, we have to wait and see who that next Fed chair is. And then after that occurs, the markets will have to adjust to a new style.
Look, on the question of Fed independence, which is really the question you're asking, look, I think that in some ways politics has been part of this for a while now. In the end, the person who's chosen is going to be part of the institution. Nobody wants runaway inflation on their watch. That's the role. So ultimately, I think the person, whoever is chosen, will be aware of the inflation reads. I think the data is going to normalize going into next year, and we'll be able to tell.
Well, taking a step back, it seems like people are betting on that. People are betting on the credibility of the central bank. Particularly, you can see this in the dollar. There has been a sense that the dollar has not weakened more. It's basically traded flat since that April-May period of time. I mean, are people looking past any kind of Fed compromise here? And I guess that I would ask you that, Ryan. I mean, how much are you looking at a market that has essentially said, yes, this is a Fed that's a little less independent just because of the fiscal backdrop. But the reality is that it is a committee and it will ultimately do something that won't denigrate the superiority of the dollar too much.
Well, I think fiscal issues are still highly relevant. I mean, next year we anticipate that we're going to have a budget deficit that is close to 6% of GDP for the fourth consecutive year. Now, in order to offset that, you need extremely strong GDP growth. Now, on the positive side, we are going into next year with some positive tailwinds. We'll probably get a little bit of a V-shaped pattern in the GDP numbers, high in the third quarter, low in the fourth quarter, and then strong again in the first quarter of next year, partly because of the positive effects of fiscal impulse, right? So that can be supportive of growth. But at the same time, we know that the drivers of growth for the U.S. economy and maybe the global economy are somewhat narrow. There's obviously a lot of this benefit that's come through from AI capital expenditures. And there's a question about how much that can really support tax revenues for the federal government if that's all that's driving the economy in 2026.
Ryan Wong of HSBC, thank you so much for being with us and have a wonderful holiday season. Alicia, from your perspective, how much are you seeing a real pushback against the American first kind of idea here? Do you see a lot of clients saying it is the time for the rest of the world to perform much more significantly?
So in our client base, the answer would be no. Right. Our client base is committed to American exceptionalism, American businesses, American productivity. What we do is tactical changes in portfolios, and ultimately outperformance of rest of world is really tied to the U.S. dollar. And that's what we saw the first quarter of the year. The U.S. dollar dropped 10% swiftly. Rest of world outperformed enormously, and ultimately the S&P has outperformed rest of world since April 1st. And as you point out, the dollar's gone nowhere since July 1st. So it's very much tied to the dollar. So when we talk about allocation in portfolios, the question we have to ask, at least within the equity space, is what's your view on the U.S. dollar? The Japan issue is interesting, of course, because as the yen weakens, dollar is stronger. Do you get the trade back to U.S. outperforming rest of world? So our client base is committed to U.S. assets, large, small, mid, but ultimately we are allocated emerging market debt, emerging markets, and rest of world as well, because we do see the impact of the cutting cycle in the past year or two affecting real growth.
Japan is an interesting one, especially off the back of this rate decision, because bond yields are moving higher. How are you thinking about global allocation if we continue to get that? Because there have been past episodes where U.S. equities are challenged by when the carry trade is challenged in Japan, or repatriation back home as yields are all of a sudden attractive. Could that be a factor yet again in 2026?
It could definitely be a factor in 26. You know, as the Japanese 10-year moves higher, what does that do to the U.S. 10-year here? I think that's one of the risks for next year. Ultimately, if you get steeper yield curves globally, as you know, it's great for financials. And so all these other markets are chock full of financials. So European equities, financial, and Japan equities. So that'll be very good for markets as well. That's why we see bouts of volatility, because ultimately it's the surprises that give you the vol in markets, and something that happens with the Japanese bond market would ultimately affect here. The other thing is the most consensus trade out there is a weaker dollar for next year, which was what we had this year. And so if that changes at all, then you have global allocations that really are not working in portfolios.
Alicia Levine, you're going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. EU leaders have agreed on a more than $105 billion loan package to Ukraine for the next 2 years. The interest-free loan will help the country finance its military and economic needs amid its ongoing war with Russia. The loan came together after European leaders failed to agree on a plan to use frozen Russian assets to raise the funds. Meanwhile, former NASCAR driver Greg Biffle and his family are believed to have died when their corporate jet crashed just minutes after taking off on Thursday from a regional airport in North Carolina. A definitive list of the victims will be released once their identities have been confirmed. The FAA and NTSB are investigating the crash. And the FedEx turnaround story is showing signs of success, though shares are in the red. Earnings for the shipping giant topped estimates, and the company raised the low end of its profit outlook for the year, driven by volume and pricing gains in the U.S. However, FedEx is still working through several challenges and expects adjusted earnings to dip this period. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira, and thank you so much for everything this morning and this week. Up next, setting you up for the day ahead, plus Eric Johnston of Cantor Fitzgerald as pressure grows on the already fragile AI trade. From New York, this is Bloomberg Surveillance.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case, because we have built a new global trading order on the back of these tariffs. We will do whatever we need to do to make sure that we can maintain the tariffs we need.
That was U.S. Trade Representative Jamieson Greer earlier this morning, and it gives us a sense of just how long this year has been. So many machinations, so many twists and turns. Right now, heading into the end of the year, people are a bit dazed and confused, at least based on the price action. Not much on S&P futures. You are seeing, though, that lift for NASDAQ and Russell futures up about 0.25% in the bond space. That's been where the action has been. When you take a look at 10-year yields in the U.S., in Europe, as well as in Japan, you could see that lift higher, with a real question about the global rate cutting cycle. Is it over? And is Bank of Japan leading on the hiking scale? Meanwhile, right now, we're looking at a lot of positivity heading into next year. Eric Johnston of Cantor Fitzgerald targeting the S&P to finish next year at 7,400, but saying the risk of a drawdown in the first quarter is high, writing the AI trade is becoming more fragile. The capex numbers from hyperscalers at end of January will be closely watched. Eric joins us now. Eric, great to see you. Thank you for being here.
Thanks for having me.
So talking about the the fragile story. Why do you push back, given the fact that ultimately you have seen a lot of earnings come in stronger than expected, and a lot of people have said the sell-off so far highlights it isn't a bubble because there's skepticism, and that doesn't happen at this time.
Well, I think the backdrop is that, everything is being driven by the AI capex cycle. And what we see right now, it is very strong. As we know, we're seeing it in earnings from the Microns, et cetera. And I think it's important to realize that the capex cycle is driving GDP, right? We're seeing this anomaly of zero job growth, but yet GDP 3-4%. We're seeing it in earnings growth. Earnings, grew sales 8% last quarter. Mid-teens earnings growth, margins are expanding. So the earnings picture is very strong, but highly correlated to this build-out. And as we know, the market is a forward-looking, indicator. And so while everything is very strong right now, I think the risk is, does something happen in 2026 that gives the market pause around the direction of the capex cycle in terms of will the growth of capex continue as it has been, and I think that just creates a risk for the overall market.
You've started to see some of that risk already creep in, but at the moment it's taking the form of just targeting individual companies like CoreWeave, like Oracle. If the market turns more and starts to question capex more broadly, do you anticipate that all the AI names get thrown away, or will it be a market that's very selective with this narrative?
So I think and to be clear, I think the cycle is going to continue throughout 26. It's just that I think there's going to be scares along the way. And when you get those scares, there's so much in the S&P, not only in tech, that is tied to it. So you think about some industrial companies that are benefiting from the construction of all these data centers. Obviously in utilities, so many different aspects. And then of course within tech, semiconductors are at the heart of it. So I think if you do see a broad concern around a capex cycle that is turning, then it would have a much broader impact on tech. But one of the things we've seen of late is, the picking of winners and losers. And I think that's going to continue. I don't think, it'll ever be sort of a broad take on just because there's so many different players, and there ultimately will be winners and losers.
I do feel, though, like it's a market that is trying to pick through and find where those winners are. And the narrative has been, we're broadening out. It's not just the picks and shovels. We're looking at people who can benefit from AI. What about business models that are getting destroyed by AI? You see that in the likes of Salesforce, for example. Are there certain sectors where you just would not touch at the moment because of the uncertainty of the impact AI will have on their business models?
So I actually think that those names are actually going to perform well in 2026 just because they've been thrown away in 2025. Salesforce is a great example. So I think there's been a much more draconian view around how quickly AI is going to, hit companies that have products that maybe in the future down the road could be severely negative impacted by AI. But I think the market's taken far too aggressive a view in terms of the timing of it and actually how it's going to play out. So I think names like Salesforce actually could do very well in 2026 as the market starts to take a step back and say, hold on, this actually may take longer. Their products are not going away, et cetera. And there's a lot of names like that that are very similar to Salesforce, and it even goes beyond tech, whether it be the consulting firms tied to labor, et cetera.
Well, there's this idea of dispersion here, right? And Alicia, I'd love your thoughts on this. Alicia Levine from BNY Wealth with us this morning. There is this question about how much people are going to start to question the financial prospects of some of these companies and how much the proof is really going to be in the pudding. And you could get some selective defaults. You could get some real questions around whether the OpenAIs of the world will keep getting the money that they're asking for. How much are you kind of looking to this as being a hiccup, whether it comes through the financial sector, whether it comes through private credit, or whether it just comes through in specific stock selection?
So I think, look, we're in the middle of something of an industrial revolution here, and not all entities are going to be winners here. And even year to date, if you just look at the Magnificent Seven, which pretty much overall have benefited from the AI trade over the last 24 months, only 2 of the 7 have actually outperformed the S&P this year. So, the market is always trying to pick winners and losers in whatever era we are. I'd say there is risk there. I don't think the risk is going to be overall, but to particular companies, that would definitely be the case. But if you just think about the conversation that we were having around this table, let's call it February and March, when we weren't talking about tariffs, we were talking about the companies, in the top 10 who were not investing in AI, and were they going to be left for dead, or business models were going to go away altogether, being eaten by ChatGPT. And it turns out those are the companies doing great right now. So I think it moves so quickly that piercing through for the next 12 months, which is what you really have to do at deploying new capital today, where the market's going, you can't do it day by day. I think it's too uncertain, but ultimately there will be winners and losers here. But the ones that are winning may not be the ones today that we think will.
All right, both of you, real quick here. What's your highest conviction contrarian trade heading into 2026? Eric?
So I'm not sure how contrarian this is, but a rally in the bond market. So I think in terms of the long end of the curve, I think we see the 10-year yield, drop into the threes, mid to maybe upper threes. And that's for a number of reasons. I think inflation has peaked, and I think we see inflation come down throughout 2026 due to weak labor market, weaker wage growth, oil prices at the lows, et cetera. And then I think the Treasury will be aggressive around trying to get back-end yields lower for housing purposes, and there's a lot they can do, especially if you can get the Fed funds rate down to the 3% area, moving issuance and doing things like that. So I think the 10-year yield will go lower, will break 4% in 26.
Alicia?
So growth 2.5+% as a right tail risk. Inflation lower second half of the year, and the new Fed chair fits in just fine, and there's no institutional angst over it.
Alicia Levine, thank you so much for being with us this whole morning. BNY Wealth. Eric Johnston of Cantor Fitzgerald, thank you so much. Both of you, thank you so much for spending the last trading day of the year, at least the last trading day of the last full week of the year in 2025. Danny, what a morning. I mean, honestly,
heading
into
next year. I wish it was the last day of the year. I know.
Well, I think President Trump is trying to make it so. Coming up on Monday, Marvin Lowe of State Street, Sucharita Kadali of Forrester, Neil Dutta of Renmac, and Fed Governor Stephen Myron. Don't miss that. This was Bloomberg Surveillance. Have a wonderful weekend and have a wonderful holiday. This is Bloomberg Surveillance.